person needed wood. One person needed the wood for fire, the other person needed fish to eat. And if you have an excess of each, instead of pretty much you're not using it, you exchange it for somebody else for something that you need. So now in Forex trading, we're obviously not trading fish for wood. We're trading one currency for another currency. For example, the euro being traded for the US dollar. The US dollar being traded for the Great British Pound. Have you guys ever gone to the airport and as soon as you get off of the plane, you see these big exchange money spots that you can pretty much go to, and if you're in a different country with a different currency, you can exchange $100 for $100 of that currency's actual physical dollar. We have all actually participated in the currency exchange participation, and this currency trading happens every single day. I'm talking trillions of dollars. Yes, trillions, not millions, not billions, trillions of dollars that are being exchanged every single day. To have the exact number, it's actually $6.3 trillion is moved in the market every single day. So when you're trading the foreign exchange markets, you're trading one currency for another, but you're not actually buying currency tangibly. And you're not going to get this money in your bank account, or you're not going to hold it in a reserve account or in a different exchange. You're not doing any of that. You're simply betting if price will be going up or if price will be going down. You're essentially betting that the currency will get stronger or weaker versus the other currency. And the way that this works is by fundamentals. It's by the government, by the interest points of that country, by the banks behind that country and their funding, by the economy of each and every country. And if the country gets stronger than another country, that currency will rise, making it stronger than the other currency. So there's a spread there that it will go up in value and you make money on that spread. And let's say if a currency gets weaker than a different currency, then there's a spread that you can also make money on that as well. So for example, let's say that the US has had a recession and the euro is actually in a booming market. That means that the US dollar is going down and that the euro is going up. This is where you would want to buy the euro and where you would want to sell the dollar, because the market is clearly bad with the dollar. So you want to put sells in that the dollar will go down, and you want to put buys in that the euro will go up because it is doing better than the dollar. It's almost a win-win scenario because the fundamentals are driving price down for the US dollar and driving it up for the euro. Now, bear in mind, you're not only just buying the euro or you're just only selling the dollar. You can't do that. You have to bet on a currency pair. What is a pair? Well, it's, two things. It's like when you have a pair of shoes, you have your left shoe and your right shoe. If you have a pair of sandals, you have your left sandal and the right sandal. So when you have a currency pair, you have one currency pair and then another currency pair. And what they're doing is they are together battling each other. Who gets stronger than the other? Who's driving price up and who's driving price down? So for example, let's use Euro USD, which is the most known pair in the whole entire foreign exchange market. It is the most traded currency pair in the whole entire market. It has the most volume and the most movement, meaning that there's more opportunities and how you can actually capitalize off of it, but more on that later in this video. So when you're actually trading the foreign exchange market, you have to trade on a currency pair. Euro USD. If you were to buy Euro USD, you are betting that the euro is going to get stronger than the dollar because the euro drives price up. And if you were to sell Euro USD, you are betting that the dollar will get stronger than the euro. And that is because in the Euro USD pair, the euro is the base of the currency pair, and then the USD is the quote. So basically the euro is what drives the price up, and then the USD is what drives the price down. So if you see the price going up, that means that the euro is getting strong. And if you see the price going down, that means that the USD is getting strong. So if you want to bet on the dollar getting stronger, you have to sell Euro USD because the US dollar is going to get stronger than the euro. And if you want to buy Euro USD, you are betting that the euro will get stronger than the dollar. And this works for all currency pairs across the market. For example, GBP USD. It's the Great British Pound versus the dollar. So if you buy GBP USD, you are betting that the pound will get stronger than the dollar. And if you are selling GBP USD, you are betting that the dollar will get stronger than the pound. And in the foreign exchange market, there's thousands of pairs. I'm talking literal thousands. Like you can have the US dollar against the Mexican peso. You can have the Mexican peso against the Russian dollar. And that is the beauty of this market. There are so many different types of opportunity because there is so much more money being moved than the stock market, than the futures market, than even the crypto market. There is $6.6 trillion being moved every single day because this is a market of the whole entire world, of all the currencies in the world combined in one single market. Compared to the New York Stock Exchange or US 30, you're only dealing with the companies inside of the United States, which can only be so big. So that is pretty much a very entry level of what Forex is. Now there is many markets out there like futures, commodities, cryptos, options, and there's great opportunities there, but nothing compared to Forex. So now let's actually dive deep into actually how this market works and how you can learn everything you need for you to be able to go battle this market every single day. So now that you've seen that there's different types of currencies that you can actually trade all around the world, now there's actually different types of formats that you can trade. There's different types of way on how you can approach these different types of currencies that they all move very different. So to begin with, you have scalp trading, which is known as the lower time frame traders. These are the traders that have the faster movements, that they're in the market a lot less time. They have a higher win rate, but a lot less of a risk to reward. These are traders that usually are kind of stuck in front of the market the majority of the day or the majority of the night, that they have to dedicate hours sitting in front of the computer to just find one little good opportunity because they're only in the market probably within 1 to 2 hours of the market movement, which they can either be winning very fast or losing very fast. And some scalpers can either enter 1 to 3 trades every single day in order for them to make some money or just make back losses from the previous day, because the majority of the scalpers will lose the majority of the time because they're taking a lot of trades constantly. And scalp trading is actually the most attractive type of trading that beginners kind of approach to it because they just passionate about trading and they want to be in front of the charts as much time as they can. So they approach scalping thinking that's going to be the best way for them to make money. Next, it leads me to day trading. So I'm sure we've all heard the term, oh, he's a day trader, or I know a day trader. Well, it's actually a very common term because it's what the majority of the people that work a 9 to 5 attempt to do. Because for you to be a day trader, you pretty much have to be in front of the markets while you're in a job. So people kind of treat it as their side income. And day traders are usually in front of the markets a little bit less time than scalpers, but they are definitely taking a lot less trades. They would be taking maximum 1 trade every single day, because anything more than that, you fall into the category of scalping. And day traders are a bit more selective when it comes to the trades, and their trades can last anywhere from 1 to 3 days to play out. Unlike the scalpers, that their trades can last anywhere from 1 to 2 hours. So day trading, your trades are actually being held 1 or 2 days compared to scalpers, which is a little bit of a time. Next is going to be swing trading. So swing trading is actually a approach of the market where you are swinging the market, meaning you're just chilling. You're going to be in maybe 1 position a week, maybe 2 positions a week if you find a good probability trade, and you'll hold it throughout the weekend. So you'll be in the position for anywhere from 4 to about 8 to 10 days. And these positions usually run a lot longer, giving you a lot more profit. And you actually have to do a lot less work. You're probably in front of the market for 1 to 3 hours every other day. You don't have to be involved in the market that much, because as soon as you enter a trade, you're pretty much letting your trade ride until it goes in your direction or against you. But swing traders are taking a lot less trades but they are risking a lot more compared to the day traders and compared to the scalpers. And swing traders usually tend to have the highest win rate because they're being very, very selective on the type of trades that they take, because they're only taking anywhere from 1 to 2 trades a week. And then next is going to be position trading. So position trading is a trader or investor that pretty much enter a trade with a long-term vision. They want to be in the market for anywhere upwards of a month, and they are not looking to liquidate their position anytime soon because they're treating it as a investment, as a position that they're entering in the market. So they're prepared to be involved for about 1 to 2 to 3 months to just simply have their trade get as much profit as it possibly could be. And position traders or investors, they'll probably take 1 to 2 trades a month, if any. Usually they stick to 1, and they're looking to minimize their losses as much as they possibly can. And investors and position traders are actually the ones that lose the least, because even if their positions go into a loss, they're going to continue to hold it long enough until it goes into profit. And if you hold a trade long enough, it will go back into profit. So as you can see, every single format of trading actually scales up on the amount of time that you're actually holding a position. A scalper is involved in the market anywhere from 1 to 2 hours a day. A day trader anywhere from 1 to 2 to 3 days in the market. And you have a swing trader where it's anywhere from 4 to 8 to 10 days. And then a position trader where it's upwards of a month. So every single different type of format in trading, they are actually holding their trades longer, but they're actually taking less trades. So as the formats, they scale, so does the time they hold the trade, but the amount of trades they take is a lot less. And all of these different formats you can actually apply to all of the markets. You can apply it to foreign exchange trading, to commodities, futures, options, crypto, everything that has pretty much a chart with candlesticks that go up and they go down. But the best one, and the one where I've had the best experience and the most success, is going to be Forex trading. That is because it offers the best things that no other market can offer. It has 24/5 access, meaning you can trade Monday through Friday, any hour out of the day. So if you work a job, you can trade when you get out of your job. If you're up late at night, you can trade late at night. If you're up early in the morning, you can trade early in the morning. Compared to, let's say, options or stocks, you can only trade 9 to 5, which kind of sucks, because if you have a job, you can't get involved in the market. You're simply limited to what you can actually do in the market. The next reason why it's my favorite and why I got involved is because the entry barrier. For you to get started in Forex trading, you can start with as little as $100, or compared to the stock market where your entry barrier is going to be $25,000 as your minimum first investment. And I don't know about you, but when I first started trading, I did not have that kind of money, so I simply couldn't get involved. Another reason why it's the most reliable is because you're literally trading money. It's impossible that the currencies of the world simply disappear from one day to another. If that happens, we're in a big problem, but that will literally never happen. Compared to a company in the New York Stock Exchange, they can simply just go bankrupt one day or get sued and you're done for. Or a crypto can pretty much get rug pulled and all your money is gone from one day to another. The currency exchange market is here forever, and it is going to be here forever. Countries run on these currencies, and they need to do that for it to keep going. For that reason why the currency exchange market only gets bigger year after year, and the opportunities are going to be there forever. And adding up to that, you can actually get involved for free. You can actually test and apply the markets and try and figure out if it's going to go up or down with fake money. You can use demo money to test your skills and learn it before you actually put real money at risk. And when I was trying to get involved in the crypto market, this simply wasn't a thing. They don't allow you to use this with fake money. It wasn't even an idea. Versus in the foreign exchange market, not only can you access it whenever you want, you can actually test it with fake money, which is actually really cool. And if you don't know what demo is, it's pretty much simulated markets. It's demo. It's not real money. It's paper trading, fake trading, where they just give you fake money in an account where you can get and pretty much go test it out. So if you want fake $100,000 and you want to test out your skills, you can do that. If you have $5,000 to put into the market and you want to test out your skills first, you can create a fake account with $5,000, which is actually amazing. So that way you can actually see how far you can get with demo money, so that when you're ready to deposit your own money, you're ready. So now that we understand how the Forex market works, a very simple way, we have to understand how can we actually execute into these markets. What platforms are required? What platforms should you look at? What platforms shouldn't you look at? And this is where it can get a little complicated if you don't have the right video. And that's why everything is inside of this video, which is going to teach you the only platforms that you're going to be needing in order to be able to execute trades in the market successfully. Now, there is hundreds of different platforms. There is thousands of different people directing you to different places, but these are the only platforms that I have personally been using for the last 7 years trading in the markets. And I have never, ever needed anything else when it comes to actually executing in the market other than these platforms. And I've made probably around $10 million on just using these two simple platforms. You do not need anything else other than these two platforms that I'm going to be explaining now. And then obviously a third one that you will have to do your own due diligence on, but this is going to make sense in just a second. The first platform is going to be TradingView. So TradingView is pretty much what its name says. TradingView. You're going to view the trades on this website. This is a well-known website, I think used around about 80 to 90% of the market. And this is where you're going to be actually looking at the charts. This is where you're going to be looking at the markets going up, at the markets going down. This is where you're going to look at the markets, for example, Euro USD, how we were setting an example, GBP USD, GBP CAD, so on and so forth. Now, this platform is strictly and only to simply just look at the market. This is where you're going to be identifying if you're ready to buy or if you're ready to sell. But you will not be entering a buy or sell on this platform. It's something that the platform offers, but I personally have never used it. Neither has anybody in my community, or I've heard anybody of ever using it before. It's something that they offer, but I personally rather stick to the different options that I'm going to share with you now. So TradingView, to keep a very simple example, is just somewhere where you can view the charts. And this is a platform where you're only going to be looking at stuff. You're not going to be executing other than just things you will be drawing on the charts to identify if there's a high probability of it going up or a high probability of it going down. This is where you will be doing your charting. This is where you're going to pretty much spend, I'd say 90% of the time that you're in front of the markets will be on TradingView. Because when you actually execute a trade, it will be on a different platform. And you're not going to be looking at the numbers on the screen. You will simply be looking at the charts, because what's on the charts will reflect on the numbers on the screen, which will be on your phone or your computer, wherever you decide to actually take the trade. But TradingView is simply just so you can see the charts, whether they're going in your favor or against it. And the simplest analogy that I can put is like you right now watching this video. You're watching this video to intake the information that I am giving you, so then you can learn and then you can go execute in the market. But you're not executing a trade on YouTube. You're not doing anything on YouTube other than simply getting educated and absorbing the information that I am giving you, or that you're simply watching on YouTube. And you can watch the video in a bunch of different formats. You can watch short-term videos, you can watch long videos like this one, you can watch it in theater mode, in full screen mode, or on your phone. So there's different types of ways on how you can intake this information. It's the same exact thing with TradingView. You're looking at the charts in a bunch of different ways so you can intake the information, so it can tell you if you're ready to buy or if you're ready to sell. But you're not doing anything other than just looking at the information that the market is sharing with you on TradingView. So let me actually take you to TradingView just so you guys can get a very simple insight of what this actually looks like and what to pay attention to and what to not pay attention to, because this can almost be very overwhelming at the beginning and information overload. And trust me, it happened to me, and I almost kind of got intimidated and didn't even want to look at it too much because I just didn't know what to look at. So I'm just going to explain to you right now what are the only things that matter when you log into TradingView very briefly, and then you're going to see what you shouldn't be paying attention mention that because honestly, there's a lot of stuff here that you really don't need. So diving into TradingView right now, this is as soon as you log in, this is what you will be seeing. You will be seeing pretty much to your top left-hand side is your accounts, and you're going to see all of these tools that are randomly right here to the left-hand side that you probably have no idea what the use is for. But everything inside of here is basically a tool that you can use to your advantage to chart up the chart. It's simply things that you can use to put on top of the chart so you can create an edge on the trade that you will be taking. You will not be needing everything that is in this toolbox right here. This is absolutely excessive, and you only need to use about 7 to 8 tools out of everything this platform has to offer. So if you come back here to TradingView, this is just a simple ray example that I have just showed you, and it is really not necessary at all. Within this section, you have many different types of lines. You have the info line, the extended line, trend line, horizontal line, all these lines that literally I do not use, and you will never need to use it. You will only need to use 3 things from this line section, and that is going to be the trend line, the horizontal line, and the horizontal rate. So if you'd want it, all you have to do is put a little star. When you put a star, you will notice that it will pop up on this box right here that is going to pop up in front of your charts. This is going to be your favorited tools out of all of the ones that the platform has to offer. This is so you can pretty much filter out the only things that you need, because again, there's many things in this platform that you do not need to pay attention to, and there's many things in this platform that, as of today, being a multi-millionaire trading on this platform, that I have never used, meaning you will never need to use them either. So you just simply, I'm going to explain to you what they are, and don't even get curious on learning what it is. Simply just know that it's there and know that you will not be needing it ever to become successful in trading. So moving on, you have the channel section, and this is where there's different types of channels, pitchfork, shift pitchfork, all of these things that make absolutely no sense. And all you have to do is just completely ignore it. You will not be needing anything inside of the line section other than these 3, because this has no indication to creating an edge in the market, how I have been trading for the last 7 years. Now, there might be some strategies out there that do, but the majority of them don't really use it, especially mine. So when it comes to here on the second section, you're going to have your Fibonacci area where there's about 10 different types of Fibonacci's, and we will be using absolutely 0 of these Fibonacci's. These are all different types of random stuff that just make your chart look weird. Like, look at this. You're gonna tell me you can create an edge with this funnel or this fan, whatever this is even called? No, it simply doesn't make any sense. It's just accumulating your chart. It's putting mathematics behind it that honestly, it's not needed when it comes to trading. All you will need when it comes to trading is read the price action, which price action is the chart, but we'll get into more details later in this video. I can only get into these details when you actually know how to visually see them, because you have to see them on a platform, and this is the platform that you're going to be seeing them in. So you will not be needing any of this complicated stuff. This just makes the trading complicated and very intimidating to a beginner trader, and you don't need anything inside of this Fibonacci section along with the gain section. You can simply move on to the next section, which is going to be the pattern. Because again, Fibonacci is just an equation where you can create an edge on it, but I will explain to that again later in this video. Right now, I just want to show you what the platform looks like, and I'll get into more details later, along with the patterns that we are in this section now. And the only pattern that we will be using is going to be head and shoulders. So you can simply put a little star next to the head and shoulders, and you will notice how it's going to pop up over here to the top right hand side corner. We will not be using the ABC pattern or whatever this is. I've literally tried to figure out many times and it doesn't work. Other than the pattern section, we will completely avoid the Elliott waves and this section down here. This will not be needed in this trading approach, simply because it is information overload. These are all different types of indicators to read the market, and indicators, as many of you may know, or if you don't know, they don't have a high success rate because indicators are delayed. They take time for the markets to be able to have a reaction to them. So by the time you get your entry based off of an indicator or one of these tools,
you're pretty much late already. So we will not be paying any type of attention to any of these different types of Elliott waves or any of these types of cycles that the market has to offer. Moving into the next section is going to be the projection section. You're going to put a star on the long position and a star on the short position. This is pretty much going to be the tool that is going to tell you if you are buying or if you are selling. Simply just take a quick look at it. It's probably this green and red box that you see all the time these traders put, but don't worry about it. More on this later in the video. Right now, I just want to get you to be very familiar with looking at these things. So when I dive into detail on every single one of them, you're very educated and up to speed and they make sense right away. Moving on, we will be looking at the brushes. You only have to put a star on the brush and a star on the rectangle, the path, and the eclipse. Everything else in this section you will not be needing. You will not need to be paying attention to it. Again, it's information overload. What they did was put 4 different types of arrows. You have the arrow marker, which just looks excessive. Then you have this type of arrow. And then you have this type of arrow right here, which is just another arrow. It's just different types of ways that the platform offers services for all different types of traders, which is cool because pretty much they are meeting the standards of every trader around the world, but you're only one trader. You shouldn't be looking at all the information for traders all around the world. You should only look at what's going to make sense for you. And in this video, I'm going to only show you what's going to make sense for you. So now moving on to the next section is going to be this T. So this is going to be the text and the notes section. So you want to put a little star on the T and a star on the call out. You won't need anything from the content section because this is pretty much whenever you want to write notes on the charts. You can simply just write it on the text section. Or if you ever want to call out a specific section in the charts, you can just point at it and you have a call out section. These are both things that I just use to actually just have notes on the chart if you want to save it for the future, if you want to look at it when you're back testing, or if you just want to hide a message in your chart. Moving on now to this little emoji section over here. You will not be needing any of these emojis. TradingView is very clever. They literally put the whole entire emoji section on an iPhone. I don't know why they did this. I've actually never used this in my life, so I take my trading very serious. So I will not be putting any emojis or any hearts or anything on my chart. I keep this strictly to business, and I only look at the stuff that matters. This clearly does not matter. Imagine putting like a smiley face or a winky face on your chart, and then when you go show your friends your trades, they see that and they're like, what the hell? Yeah, so you don't want to focus on these emojis. Moving on, you have the measurement section. So you can't put a star on this because it will permanently stay on this section right here. But this is where you'll be measuring the trades, whether how long they are, how many days, the actual percentage it went up or the percentage it went down. This is the measurement tool that you can use to measure pretty much everything when it comes to the markets. And we're going to explain later in this video how you can actually use it. Just this is what it is. This is the zoom in and zoom out. I have never used this button and I will not be using it today because I am not interested in using it. I have never used it. This is a magnet. I have no idea what this is good for. I have never used it in my life, so we will not be paying attention to this at all. This is going to be the stay in drawing mode, which I also have never used in my life, and you will not be needing it. It is absolutely pointless. Along with this lock all the drawing tools. I never used this in my life and I do not plan to ever use it as well, and I have not used it to this day. Moving on, this is going to be the hide all drawings. This will be a button that I use frequently when I usually have a lot of stuff in front of my charts. Let's say your charts are a little bit accumulated and they're a little bit, clogged up and you want to clear it up just for a second. You can just click this button and it will clear it up, and you click it again and it brings all of your indication of the charts back. So again, you can't put a star in it. You can simply just click it and it will disappear your trades and tools and then bring it back whenever you need it. So we don't really use it, but it's good to know what it is. And then next is whatever the hell this is. I have no idea what it is. I've never used it. And then obviously, which is the trash section, you can simply click the trash and you can remove all 3 drawings, 1 indicator or 3 indicators, or simply if you want to delete something, you can just click it and you can click the little trash button, which will pop up right here. And then you can delete it if you want to delete one thing at a time. And then the last button in this chart is going to be this little star to the bottom here. So as you can see, it says show favorite drawing tools toolbar. So this is our favorite tools So this is our favorite toolbar of our trading tools. If you want to see it, you have it there. If you don't, you simply click the star and it'll disappear. If you want to bring them back, you simply click it again and it will pop up again. So for the majority of the time, I say 99% of the time, you're going to have this star open because these are your tools that you're going to use to analyze the markets to tell you if you're interested in buying or interested in selling. So this is everything that you will be needing and what everything pretty much consists of this left-hand side on TradingView. Moving on now to the bottom right of the screen, you're going to see this stock screener. I have no idea what this is. I'm going to click it just for this video, and I guess something popped up down here. I have no idea what this is. We don't trade stocks, so I will not be paying attention to this ever, and I have never paid attention to this. Same thing goes for the Pine Editor. Same thing goes for the Strategy Tester and Trading Panel. I have never used any of these tabs in my 7 years of trading the markets, so there is absolutely no need for this information here. Along with this 1 day, 5 day, 1 month, 3 months, 6 month, year, 1 year, so on and so forth, you will not be needing to pay attention to this because we will be looking at the time frames that we need in just a second. So this section pretty much all down here sums up of nothing. We will not be using absolutely anything from this section here. Moving on to this timer right here. This is currently the timer of where I am right now. As you guys can see, it is currently 2:34 in the morning Miami time. So yes, I am recording this video at 2:30 in the morning to show you guys how hard I put my time into the value that I provide to you guys. It is currently a Friday night and I can be out partying or clubbing and having fun, but I'm like, you know what? I want to make this video for an Alex when 7 years ago he wanted to get started in trading and he wanted to know everything in one single spot. He wanted to make sure that he didn't have to go watch 100 other videos and see if he can piece everything together. So I'm making this video for you guys right now, pretty much at 3 in the morning. So you guys can just watch this one video and have absolutely everything you need to learn trading and apply it to the markets. So make sure that you listen and pay attention to the things that you need and to the things that you don't need, because I am making this so easy for you guys that you do not have to go watch any other video. Everything is going to be in this video from this point all the way to the end. I'm giving 100% dedication to this so you guys can have success like me and shorten your learning curve by years. If I would have had this when I started trading, I would have been profitable in my first 6 months. But everything happens for a reason. That's why I'm here making this video for you guys now. So now going back to the chart, this is the time zone of where we currently are. And then this is a little arrow to show the panel, which I have never used. And this is just a maximize panel, which I have never used either. I have never used anything of this bottom section over here. This section over here to the right-hand side is pretty much information about the currency pair that we are interested in trading. Now, again, keep in mind, a currency pair is a pair of two different types of currency. The example that I was setting earlier was Euro USD, which is the Euro dollar versus the United States dollar. As you guys can see, this is Euro USD, the Euro versus the dollar. This is a Forex major pair. This is currently the asking price of this market, and this is just simple performance standards that the platform has to offer. I have never used any of these stats in my favor to enter a trade or to get out of a trade. I have never used this in my life. Usually what I tend to do is just put this note section so it can just not distract me and I can write whatever notes that I want right here. But I have never used the actual information that they apply when they're showing you the currency pair. As you guys can see, moving up a little bit more, you can see all of these different currency pairs. If I were to click a different one, this is the Euro and the Japanese Yen, Euro JPY. You can see the two different countries right here. This is indicating a strong buy. And I'm telling you right now, 90% of the time, this doesn't work. So there's no reason why you should ever be paying attention to it. So I skipped this little section right here, which is a metric section, which is literally where we are right now, the notes section, and then this little 3 dots. So I have never in my life ever used any of these buttons. They're absolutely pointless and they are needed for nothing in order to become successful in trading. Moving on to this bottom section right here, I guess this is an help center. I have never used it as well. And along with a calendar, which I have never used in my life when it comes to trading, especially on this platform. Moving on up here, every single one of these buttons to the top right side of TradingView is absolutely pointless. I don't know what any of them are, and I have never put any time to even knowing what they are, because from the moment that I came into trading, I just wanted to focus on what matters. I wanted to focus on what I was trading, and what I was trading is the chart. It's literally these candlesticks that are in front of you, this price that's going up and down. You're not trading all these different options. It's information overload. The only thing you will be needing is this top right button, which is going to show you your watch list, which will be the pairs that you are interested in trading. Now, what pairs should you trade? What pairs shouldn't you trade? I'm going to explain more on this later in this video, so make sure you stick around. And if you haven't subscribed, hit the subscribe button. So moving on to the top right hand side corner, this is going to be a published button. I've never used it as well. And I have never used absolutely any of these buttons that are here to the top right hand side of this TradingView ever. There's absolutely no need for it, and I have never used it. Oh, and actually a fun fact, literally just the other day, I found out what this button did. I'm talking about like a month ago. I figured out you click this button and it just zooms into the whole screen. That's how I did that right there. That's how I literally put the whole screen on that monitor. I didn't know how to do it before. I just started clicking random buttons and that popped up. Which is kind of cool, but it's not going to make you profitable. So there's no reason to pay attention to it. So if you lose your list for whatever reason, you simply click this button and it will pop up right there. Moving on to this blue list, this is where you're going to list the pairs that you will be trading. You can have a red list, an orange list, purple list, blue list, whatever color list that you want. Currently, we are on my blue list, but this is pretty much almost like filtering out your contacts. If you want to have contacts that are your favorites, if you want to have contacts that are primary, contacts that are secondary, they're all the same in the same contact list, but some are in the priority, others are not in the priority. Well, this is the exact same thing, but instead of putting it by different sections, it's by different colors. Moving on to this different button, this is going to be the symbol section. This is going to tell you exactly what symbol you are trading, whether you're trading Bitcoin, NAS, Euro JPY, Euro USD, the list goes on. It just indicates to you that this section is the symbol. This is last, change, and change again. I don't even know what any of this stuff are. Absolutely pointless to me. Along with these three buttons right here. I have never used them, and I do not plan to ever use it. That's as far as my knowledge goes with it. Continuing to the middle top section of the screen, you can see how there's these two little arrows. So if you've ever used Excel, if you've ever used Word and you make a mistake and you want to go back, you simply just click this back section and it will go back for you to where it was previously on the chart. If you want to go forward, you simply click this button and it takes you forward to the last point where you put on the market. It's very simple and it's very straightforward. This is going to be the replay button. So I'm going to explain more on this when we actually get into the back testing section of this video, because this is the back testing button. This is where you can click it and you can immediately back test the strategy as far back as you want. Let's say if you were to want to back test to right there, the market will pretty much reset to that point where then this bottom section will pop up where you can pretty much start playing the market and start creating, you know, an edge on the strategy that you're testing, or just to get confidence and learn how to read the charts over time. But again, more on this later in the video when I'm going to explain backtesting and how you can actually use it to your advantage so you can capitalize off of it. Next is going to be the alert section. So this is when you want to place an alarm on the charts. Let's say on Euro JPY, you want to place an alarm once it crosses a certain price. You simply come here and you can just put enter, and you will notice how the alarm pops up right here in the middle of the chart because you just placed it. But again, more on this later in the video when I talk about setting these alarms at strategic points, at an area of interest, support and resistance, all of this stuff, which is going to make sense later in this video. So don't worry. So this is just the alarm section, which we will be using very frequently in the charts. Next is going to be this little square button, which I have never used in my life and I do not plan to. And then it's going to be the indicator section. So you click this button and you will literally get thousands of different indicators that this platform has to offer. And you will only be needing one. And this one I'm going to explain as well later in the video. So in here, you can pretty much just search up whatever type of indicator you want. You simply just put indicator and it will literally show you thousands of different indicators that this platform has to offer, but you will only be need to using one that is going to make you successful. Moving on to this section right here. These are the different types of chart ways on here you can read the chart. You can read the chart on bars, candles, hollow candles, volume candles, all different types of candles or lines or different ways how to read the price that the market is showing. And you will only be needing two, which is going to be the candlestick section and the line section. So you'll be putting a little star on that, and then instead of it popping up on your tools, it is going to pop up on this section up here. So you can see you put a little star and it will pop up in this section right here. Now, moving on to the next section is going to be the time interval. These are going to be the famous time frames that you're trading. What is a time frame? How does that work? How can you do it? What are the right time frames? I'm going to tell you more about that later in this video. This is just so you're familiar with it and you know how to look at it on TradingView. As you guys can see, there's a 1 minute, 2 minute, 3 minute, 5 minute. There's literally hundreds of different types of way you can read the market in terms of time frames, but we will only be using 7 of these time frames. We're going to be using the 15 minute, the 30 minutes, the 1 hour, 2 hour, 4 hour, daily, weekly, and monthly. So you will be putting a star next to the time frame that you will be using. As soon as you put the star, it'll automatically pop up on this section right here, and it will forever be saved as the time frames that you are using to execute on the market. And you will not need to be using any other time frames other than these. This way, you only focus on what matters. There's so much information on here that if not read correctly, you can get confused and it can be very overwhelming and it can throw off your whole entire trading. So you only want to focus on just these time frames, and later in this video I'm going to teach you exactly how to use them. So now that we understand everything within the actual TradingView platform, let's actually get into the charts, right? These boxes that are going up and down, because I want you guys to understand everything that this platform shows you, so then we can move on to the next platform that you should be using and what platform you should be avoiding. So let's actually get into the charts. So as you guys can see over here, kind of in the middle of the top section, you can see how we have already favorited the candlesticks and we have favorited the line chart. So right here, this is going to be called the candlestick charts. So every single one of these boxes right here is considered a candlestick. This is a candlestick going up. This is a candlestick going down, another candlestick going down, candlesticks going up. This is basically the candlesticks representing price going up or price going down. Now, every single one of these boxes, they currently have a time frame. And this is right now the daily time frame. As you can see, the daily is highlighted in blue. So this is indicating to us that every single one of these boxes is a day. It's 24 hours in order to create each and every single one of these boxes, or also known as candlesticks. So if we were to simply flick down to the 4 hour, so we click this button right here and then it takes us to the 4 hour. You can see it right here as well. Each and every single one of these boxes is now 4 hours, meaning it takes 4 hours for this candlestick to close. And then if I go down to the 2 hour, it's literally the same thing. Every single one of these boxes is a 2 hour candlestick, meaning that it takes 2 hours from the moment this candlestick candlestick opens for that to then close. As of right now, you can't see the time over here to the right hand side corner because the market is closed right now. It literally just closed. You guys can see down here that the market is closed. But if you were to see a little bit, like 5 minutes back and forth, you can see how when we're flickering through the time frames that you can see how much time is left in order for the candlestick to close, because this platform will tell you how much time is left. And then if we go to the W, it's going to be the 1 week. So as you guys can see, if we hover over it, it is a 1 week candlestick. So every single one of these candlesticks is a weekly candlestick. Very self-explanatory, very simple, very straight to the point, just basically explaining that every single box is going to be the time frame that you have been selected, right? So now we have this line chart. So we come here and we click this line. It's literally the same representation in price, but now you're looking at it as a form of a line. You're not looking at boxes, you're not looking at candlesticks, you're not looking at anything other than lines going up and lines going down. It is the same exact price, but it's just showing it to you in a very different way. For example, let's say you were to look at a human body with your vision. That can be the candlesticks, because you can see more details. You can see more into the specifics of the hairs, the features of a person. And if you want to see a different version of the human body, let's say you were to look through a thermal vision. So you're still looking at the same human body, but now you're only looking at the heated parts of the body that the thermal vision binoculars represent. Compared to if you were to be looking at with your regular vision, you can see everything other than the heated vision. So you're looking at the same human in just two completely different ways. Now, this is the same exact market. You're just looking at it two completely different ways. You're looking at it one with more details, which would be the candlestick market. And then if you want to look at it with less details and you just want to look at one specific thing, you would look at the line chart, which in the vision example, it would be the thermal vision. But we are going to be 99.99% of the time looking at the candlesticks or the market in this candlestick market. Same way how you look at humans, you pretty much look at humans 99.9% of the time with your regular vision. You don't really ever use the heated thermal vision. So now continuing into a little bit more detail, you guys can see all of these different colored numbers that you guys see here to the right hand side corner. This is pretty much how the platform differentiates things that I have selected in the chart. So for example, this blue line right here, it's pretty much indicating to you the live price of where this price is. This red box, it's just indicating to you that it's at that point. This black line is at this point. This blue box is at that point. It's simply just the representing of whatever you put on the chart. It just shows it here in a numerical version. For example, if I were to go to GBP CAD, which is the same exact currency pair that we're currently on, but let's say on FXCM, if you notice right here, I don't have anything on my chart. So we can go to the daily time frame and I have absolutely nothing. So let's say if I were to get this box and I were to simply just grab it and drag it like that, you would see how it would pop up over here in blue. Or if I were to come and I would put a horizontal line, see how it would pop up here in black. If I were to add a risk to reward tool, wherever this is placed, you see how it will move there. If I drag it down, you see how it will pretty much chase wherever price is going to be, depending on where that line is. It's just a different way. Instead of you seeing it visually, you can see it with the numbers. Those numbers are going to be very useful for when you're going to be entering a trade, but we still have a long way to go before you actually enter the trade. I have to teach you how to actually read the market so you can make money with it, and then actually how you can apply your entry to the trade. So this will become very useful later down the road, but I'm just explaining to you what it's for right now. So this is just a different way of looking at the objects that you place on the trading view, but in a numerical version. And then this section up here, I literally have no idea what any of these things are up here. This just simply moves every single time I move the mouse. I guess it's a different way of measuring where the mouse is in a numerical version. For whatever reason, I guess it's used for algos and stuff. I have no idea. I've never used it in my life. I don't like it. It's kind of annoying. It's always moving. And then obviously this over here is just explaining the server you're on, the time frame, and then the currency pair. And this is pretty much the seller price and then the buyer price that this market is offering. and then here if you were to have an EMA. So right now, if you have been copying absolutely everything that I've been explaining to you, you do not have the EMA set on correctly just yet. And I'm going to be doing that later down this video, so you can have the same exact EMA that I do, which is an indicator that I use that gives me advantage and an edge over the market. So make sure you stick around so you can get the exact EMA that I use, and you can make money with it every single week how I do. So with this right here, we'll explain later down to the video. There's just a little promotions tab of what TradingView is, and that's pretty much it. Everything on this platform right here. Obviously how you read this market and how you read these candlesticks and how you read this line chart, we're gonna get into a lot more detail. This right here is me just explaining to you what the platform is, what it consists of, how it works. Now after this, I'm going to explain to you exactly how you can learn and make money with these stuff. But before that, I have several other platforms that I have to show you for you to use so you can take it to your advantage, and you don't have to get lost in other platforms and waste time learning things that you simply don't have to learn. The next platform is going to be a position size calculator. This is going to be where you're going to calculate your risk. Now, if you're a beginner trader and you're watching this, please, the faster you get this, the better, because I did not get this until about a year and a half into my trading, and I lost so much money because I was just being greedy. I was honestly just being a gambler. I just simply wanted to come in and wanted to make $1 million off of 100. And just because the opportunity is out there to do that doesn't mean it's a sustainable way to trade. And it definitely is not something you're going to do for the longevity of your journey. So this platform that I'm about to show you is going to give you a reality on how you should trade and how to calculate your risk correctly. So this platform is going to be called Position Size Calculator. So as you guys can see, I come up here to the top right corner. I'm going to put Position Size Calculator, and as soon as this, you click enter, you will see how my FX book position size calculator will pop up. Now, there's many other position size calculators out there. I have tested all of them. This is the one that I like. I'm not getting paid for promo. This is a very known website. It's super famous. I just like how this platform explains it. So if you come here to this platform, you will be able to see how you can pretty much calculate your risk. Very, very simple. So if you were to come here and you were to create the currency pair, if you were to add the currency pair that we would be trading, let's say we would be trading GBP CAD, for example. How can you tell us the currency pair? You can see it right here. You can see it right here. You can see it right here. You come over here to your position size calculator, and you would pretty much place the currency pair that you are looking to trade. So obviously we're looking to place GBP CAD. And then you would place the account currency that you have. Currently, I am in the US, so I would have to place a US based currency account. But if you are a Canadian, if you are in the Europe, you have the pound, the Japan, whatever type of currency your current account is, that is where you're going to then select the account that you simply have. Then you're going to place your account size. So let's say you have $1,000 that you want to risk in the market, right? So you have $1,000 that you have currently right now in your trading account, and you're asking yourself, how much do I risk? Well, how much are you willing to lose? Because you have to have the mindset of every single trade that you're going to take that you can immediately hit stop loss. And if your trades immediately hit stop loss, you have to be completely okay with that loss. You can't simply deposit $1,000 and bet the whole $1,000 thinking that you're not going to lose it all. Well, if you don't calculate your risk correctly, that's exactly what's going to happen. So for example, let's say out of these $1,000, let's say you want to risk 5% out of this $1,000, which is reasonably high risk, but I'll explain more later this in the video when I talk about percentage-based entries and stuff like that. So let's say you want to risk 5%. You simply come here, you put the number 5, and then the amount of pips that your stop loss is. So this is very simple. And again, we'll get into more details on this later on, but we're just going to use this stop loss for example. This stop loss I had a total of 44 pips. This is how it is measured. And again, I'm going to get into more details, how you just use this tool and how you use this risk to reward later down the road. So don't even worry. And we're going to get into more details. For now, I'm just going to pretty much go straight to the point just so you can see how you actually calculate the risk and how this platform works. So this right here is going to be a total of a 40 pip stop loss. What is a pip? Again, I'm going to explain this later into the video. It's literally the next subject that is coming right after this. So right here, you would have a 40 pip stop loss, and then the lot unit would always stay 1. I'll explain this as well later down the video. You simply click calculate, and then boom. You're going to risk $50 on your account, and this is the unit or the lot size that you're going to use. It's that simple. All this platform does is calculate the risk that you want to place on your account. So you can place the amount of units, or you can place the actual lot size that you want to bet on this trade. Whether you're going to buy or whether you're going to sell, the same exact thing applies. As you can tell right here, there's no different option that you can put, oh, if I'm buying or if I'm selling, because the risk should be the same, whether you're interested in buying or you're interested in selling. But more details on what these other different vocabularies are and how you can use them, because I know they can be very intimidating at the beginning, but they're actually very simple. So now that you understand where you can calculate your risk, if you don't understand some of the words in there, don't worry, I'm going to explain to them. You're going to get them right away. There's one other platform that I personally don't use, but I can see a lot of you guys looking for somewhere to find it, and I'm going to simply make it very straight to the point. I don't use this platform anymore because I'm a successful and profitable trader and I don't need to know these things, but I can understand as a beginner trader, it can create curiosity and you want to know where you can get a reliable source that's going to give you this information. So I'm going to give you the third platform, which is going to pretty much tell you where you can find all the fundamentals and if they're going to be good, if they're going to be strong, if they're not going to be strong. This is so you can know exactly what's going to happen in the news section of trading. With my strategy and how I trade, I don't use this at all. But at the beginning, when I was learning to trade, this platform made things so much simpler that all I had to do was just go to this one place and I would know exactly what's happening for the next 2 to 3 weeks with news articles, and it would simplify things a whole lot. So we don't trade with news. We don't need it at all. But I'm going to explain to you how you can simply learn how to read it if you're simply curious about it and you don't have to waste time looking at other platforms and simply just wasting your time. This one platform does absolutely everything. Now, this next platform is going to be called forexfactory.com. So again, this is not a paid promo. I wish these guys would be paying me right now for this video. They don't, but they've been around for years, even before I got started. So this is Forex Factory, which is going to be the platform that will tell you exactly the news that is going to be happening in the markets. So you would want to come here to calendar of the actual Forex Factory. As soon as you come to the calendar, you would want to then click over here, this filter section. And on this filter section, you want to then only have favorited the red news articles. You can have favorited all of them, but they simply won't be effective. These are all different type of news articles that are going to come out. They're going to simply affect your trade for good or for bad. You simply will never know. I have tried to create an edge around this and it never works because you never know what's going to come out on the news. You can have an idea, but you're never going to have absolutely any idea. There's no facts behind that. You don't know what's going to happen until the news comes out and says what's going to happen. So there's simply no reason you should be wasting your time here, but it's a good way to get educated and just simply be aware of when it's going to be coming out. So back to the platform, you guys can see how it tells you the day that the new article will be coming out, and it will be telling you the time along with the currency pair that it's going to be affected and the impact that it will have and what it is related to. As you guys can see, they have a potential forecast of what they believe it can be and what the previous time there was a news article like this was, and then the actual outcome, but the outcome only happens after. If I were to simply go to the next week, let's say if I were to click here on this week, you guys can see how Sunday, April 7th, at 7:30 in the afternoon, there's going to be news about the Japanese yen with a yellow impact news, which really does absolutely nothing. It's literally somebody probably coming out and saying, hey, we're doing great, or hey, we're doing cool. It does nothing. So this is a news about the average cash earnings, which, as you can see, the previous time it was 2.0%. They forecast, they believe, for it to be 1.8, but the actual you don't know until the news comes out. Usually, sometimes they're good, sometimes they're accurate, but at the end of the day, it does nothing for your trades. If you notice right here, they predicted this one pretty well. They predicted this one pretty well. And these are all different types of ways that you can simply confirm if your trade's going to be going in your favor or going against it. I don't know. I don't really ever look at it. But this should be the only one-stop shop platform that you should look at if you're interested in looking at any types of fundamentals when it comes to the news. And if you notice, if you just want to focus on what matters, you simply come here and you exit it out of all of the news articles that are not the red ones, because these are the only ones that will have impact towards your trades. And this is the only section that I look at on Forex Factory. I have never used the forums, the trades, the news section within itself, the market, the broker, like none of these stuff I have ever used inside of Forex Factory. I only used to come in here to know when is a news going to come out and at what time, and does it affect my trade. And I know this might be something very direct and you might not make any sense right now, but I will circle back to this later into the video when we're actually entering a trade, when we're gonna have our percentage based entries, and there you can add this or not add it. But this is basically a one-stop shop where you're gonna pretty much know that some things can potentially go down X date at X time, and they're gonna be talking about X type of currency pair. Now, if you want to use it to your advantage, you could, but just know that there will never be absolutely any guarantee that you can create an edge on it, because there is clearly no confirmation until the news comes out. So far, we have 3 different types of platforms. The first one is going to be TradingView. This is where you're going to physically be seeing the actual markets. The second one is going to be MyFX Book Position Size Calculator. This is where you're simply going to be calculating the risk that you are going to determine if you're going to take the trade or not. And then the third one is going to be Forex Factory, which is going to be if you want to then use news to your advantage, or if you don't, or if you simply just want to be aware of when there's going to be news so you can avoid getting into a trade. These are the 3 platforms as of right now that I have been using for the last 6-7 years, and they have worked perfectly. Next, I'm going to be talking about one more platform, and it's the platform where you actually execute the trade. And this is going to be MetaTrader 4 and MetaTrader 5. I'm sure you guys have heard of it before, or you guys have seen screenshots of these gurus showing $25 million on a phone and all this stuff. And this is actually a very well-known platform. It's pretty much what 99% of the industry uses. It's actually the only platform I have ever used, and it is very simple and it is very straight to the point. And this is where you will actually be executing the trade. So if you analyze a trade on TradingView and you calculate your risk on MyFX Book, where do you actually plug in your trade? You will be plugging in your trade on MetaTrader 4 or MetaTrader 5. What's the difference between MetaTrader 4 and MetaTrader 5? MetaTrader 4, think of it as the iPhone 11, and MetaTrader 5 as the iPhone 15. It's simply a much bigger, updated, and newer version. I personally still use MetaTrader 4. I like it. It's very comfortable to me, and I don't have a reason to update to the next one. I simply like it. Some people like the newer one, some people like the older one, to each their own, but they both have the same exact functions. MetaTrader 5 just looks like an updated, newer version. MetaTrader 4 simply looks like the first version. The buttons, everything is absolutely the same. The speed, execution, everything is exactly the same. So there is a web version of this, which is for a computer. And then there is a mobile version for this, which is for your phone. This is pretty much where you see the majority of people doing it. I have only done it on the mobile. I did it 3 or 4 times online. I didn't really like it. It's like very old, but I like it on the phone better. It's very accessible. It's very straight to the point. So this, I'm going to actually teach you how you can use it when we're going to take a trade together in this video. So you have to make sure you stick throughout the whole entire video, because we're going to actually take a trade together with what I'm going to teach you. And as soon as I'm going to take the trade, then I'm going to show you how you can use the platform to your advantage. So now that we added MetaTrader 4 and MetaTrader 5, this is where you're going to actually execute onto the trade. This is where you're actually going to enter the position that you're analyzing on TradingView. Now, these are all the platforms that you are going to be using pretty much every single day. Now, there is one other platform, and that is going to be a broker. So a broker is pretty much the middleman in between you and the market. So you can't simply right now decide, all right, I'm going to go into the market and I want to trade Euro USD and put a buy. That's not how it works, because the market doesn't accept retail traders, because you need to have hundreds of millions of dollars to get involved in a $1 trillion market that moves that every single day. So that's where the broker business came in, that the big markets give liquidity to the brokers, so then you can execute smaller positions as a retail trader, which is what you are watching this video, what I am, and what pretty much 70% of everybody inside of the market. The big banks are the main ones that move the market. Retail traders don't do much. So this is where the broker is going to give you a fee for executing your trade into the market. So picture you over here wanting to enter a trade. And then this is Euro USD, the trade that you want to enter. You simply can't just go from here to the market. It's not how it works. There has to be a middleman, and that is going to be the broker. So you have to go to the broker, you tell the broker the trade you want to take, and then they will execute into the market. So the way that this used to work before used to be based off of phone calls. So people would simply get on a phone, call the broker and be like, hey, execute this trade for me. This is where I want to get out if I'm wrong. This is where I want to get out if I'm right. And that's where you would see the Wall Street people pretty much, running everywhere on the phone with these paper slips, because they would have to go to the broker with the slip so they can execute the trade for you. Well, that was like 100 years ago. That's not how this works anymore. The way this works now is simply through a couple of touches on your phone, because obviously that method wasn't being super productive and it wasn't targeting the masses of retail trading. It was a logistical mission. So the way that it is done now is you simply go to a broker, you deposit your money into a broker, and when you deposit money into the broker, you simply find the currency pair that you want to take the trade with, and you execute the trade. Now, you're going to see that immediately when you enter the trade, you're going to be negative in a position. Why? Well, that's because the broker business is on a spread. In order for them to connect you from the broker to the market that you want to be trading, they charge a fee. And that fee is going to come immediately as soon as you take a trade. Simply how the industry works and how the broker business works. And the simplest analogy that I can put are like tolls on the highway. When you want to get from point A, which is your house, to let's say point B, which is going to be, let's say, the beach, in order for you to get there, you have to go through the highway. You can't just simply cross from your house to the beach. No, you have to go through the road. And in the road is going to be a toll, which you have to pay a couple of cents or $1. Obviously, depends what country of the world you're in, if you even have tolls. And this toll is going to charge you a fee so that you can get, obviously, to your location. So this is a simple example of how to understand what the broker does. Obviously, the toll does nothing for you. You have to drive yourself to the destination, but it's the cost of you having to go to the beach. Whether you get to the beach or not, you still had to pay that toll. Whether you win or not, you still have to pay that fee to the broker, because they executed you into that trade that you wanted to take. Now, what broker should you use, or what broker do I use? So I am not going to recommend anybody to any broker. There's 100 million brokers out there. There's 100 million regulations. There's 100 different million everything. I personally do not want to recommend you to a broker, simply because I don't want to have any affiliation towards where you put your money into. I don't want to get paid off of a code. I don't want none of that stuff. And trust me, it would be really nice for me to do that, because I can easily make hundreds of thousands of dollars a month by referring you to a broker. But I'd rather take the more genuine route and just simply let you do your own due diligence, and wherever you decide to go, you can go there. I make my money trading, and I want nothing to do with affiliation to brokers or to any platform that I simply have no control over, especially if they're going to be
receiving your money that you're going to be investing into then scale. So I'm not going to recommend you to a broker, but the simplest things that you should look for a broker is going to be regulation and reputation. You don't want to go to a broker that is just getting started, and you don't want to go to a broker that is not regulated. It is not worth it. You want to go to a broker that has regulation, so they are at least held liable if something happens. I'm sure you've seen the biggest exchanges go down, the biggest brokers go down. Imagine how that works for unregulated brokers. Those things disappear in a heartbeat. So you want to make sure that you only go to platforms that are regulated and have the best reputation possible. But if you were to literally put a gun to my neck, if you go like this, the only broker I would ever recommend, and I'm not getting paid for this at all, would be Oanda. Oanda is the most regulated platform pretty much on the face of the earth, and the only one regulated in the US. Kind of sucks because they lower your leverage and they have a lot of restrictions because they're a super regulated platform, but your money is as safe as it could get there. If you want to know more about broker, please go do your own due diligence. And if you want to then find the broker, make sure they have as close to the requirements as Oanda does. So now that we understand all the different platforms that you need, the platforms that you're going to use, the ones that you're not going to use, what platforms should you avoid? And the platforms that you should avoid are absolutely all of them that are not these four. You do not need to look at any other platform that has not to do with these right here, because they are simply extra. They have overload of information, they are unorganized, they are excessive, and you don't need them to be successful. I have tried hundreds of them, and they have been a simply waste of time and waste of energy, waste of resources, waste of money, everything. You don't need a trading journal right now. You don't need a place to track your trades. You don't need any of that stuff right now because you simply don't even know how to trade just yet. So how do you know what you're tracking is going to work for your benefit or if it's going to work against you? So you don't need any of that stuff right now. And even to this day, I don't journal or track my trades how 99% of the retail traders that lose every single month track their trades. I track them in a very different way, and I'll also explain that later into this video. But there's not going to be any other platform that you will be needing other than these four that I have just explained. So you want to avoid every platform outside of these four, simply because they're not going to do anything to your trading and make you any more successful if you were to add it to your trading system. You do not need it. I don't use it, and the thousands of my students don't use it either. So now that we understand all of that, let's talk about the different types of trading, because with the information that I have shown you, you can trade many different types of ways. And I'm not talking about technical ways or stuff with the charts. I'm talking about actual trading concepts. There's many of them, and these are the most known ones. The first one is going to be price action trading, which is going to be the charts that I have just shown you guys. It's these candlesticks that go up, that are blue and red, and the candlesticks that go down, or the line chart that goes up and down. The ones that we just explaining just a couple of minutes ago, that pretty much represents the feed price of that currency pair happening inside of the markets. This is going to be price action. This is how you can physically see where price is on real time in front of the chart, and everything that happens in the history, meaning the candlesticks that are left in the past or the lines that are left in the past. This is pretty much like the trail of where this price is headed. This is the battle in between both currency pairs, and they're leaving a trail behind when they're going up and when they're going down. And those trails you can use them to your advantage because there's patterns behind those trails. And this is the most known common way of trading, simply because it's the easiest way to spot patterns, because you can literally see them. You're seeing it happen again and again and again. And you're looking at these patterns through the way of price action. Price action, technical analysis, charts, it's all the same thing. You're looking at the chart, which represents price that the market is showing you in a form of a candlestick. Next is going to be market sentiment. So this is a type that I learned very early on, and I had extreme failure like this because it's kind of a crazy trading concept, and it simply consists of you trading against the majority. That's pretty much it. And there's websites out there that can tell you where 99% of the retail traders are. And since 99% of the retail traders fail, you simply do the opposite of what they do. So if 99% of the retail traders are buying, you will simply sell. That's it. That's what market sentiment trading is. It's honestly a very high risk way of trading, and there's a lot of speculation because none of these platforms really know how many traders are in one direction versus the other. It's great assumption and it doesn't work. Obviously they get their price data and live feed from brokers and from other platforms, but how reliable can that really be? I tried it and I've heard stories and I've never met anybody that is successful with it. But pretty much what you're doing is you're trading against the retail traders, but you're not having an actual price that you are looking at. You're not looking at the candlesticks. You're not looking at the charts. You're not looking at technical. You're not looking at any of this stuff. You're just basing it off of one platform that tells you, hey, 99% of the traders will be buying tomorrow at 9 a.m. You should sell. But how do you know where to place your take profit? How do you know where to place your stop loss? How do you know if the entry is right? How do you know if you even have an entry signal? There's so much stuff that gets factored into this that simply makes absolutely no sense. And you're pretty much just trading off of an assumption of a platform, which to me had no sense. And I see no reliability and accountability for you to become successful using this source. Next is going to be fundamental analysis. So this is pretty much what we just explained just a little bit ago on Forex Factory. And this is going to be where you simply trade using the news. So some people out here, they love reading hundreds of pages every single morning, or they love being on top of what politicians are doing, and they study them and their moves and their team's campaign, and based off of what they've done in the past, they can pretty much assume what they're going to say in their next speech or what the next political news is going to come out. And they use that as a trading strategy to pretty much create an edge over the market, where they believe that they can know what these politicians and what these big news are going to pretty much post. But it kind of takes as well as a lot of assumption, and it's a lot of assumption based off of articles that you have to read that you don't know if some of these articles are reliable. You guys know that the media kind of makes a lot of stuff up all the time, and they give their own twist to the story. And I personally didn't want to have any reliability on social media that they can just spiral up the news to make it a little bit more spicy and they could get more attention, and me base a money decision based off of that. Or you simply have to read 5-6 different news articles to pretty much come with one overall decision, if it's going to be good, if it's going to be bad. You're pretty much just basing everything off of reading. And instead of you reading actual letters, why shouldn't you actually be reading actual charts, which is what the market does? By you reading fundamentals and you're reading the news, you're not seeing patterns, you're not seeing anything. You're just pretty much reading what the people think is going to happen. And then you making a business trading decision based off of that. And that's what the fundamentals pretty much consist of, just you reading news and base a trading decision off of that. So instead of you relying on the charts, on the candlesticks, you're pretty much relying on the news, on politicians, on social media platforms, places that direct what the news of that currency is going to be, whether you believe it's going to be good or whether you believe it's going to be bad. But same exact thing. How do you know when's the entry signal? How do you base your stop loss off that? How do you base your take profit? You can't really base it off of something like, let's say you even know for a fact that some politician is going to come out and the news article is going to mean that the dollar is going to get strong. Let's say you know that for a fact. You have inside information. Well, what do you do with that information? How do you know where your take profit is going to be if you're not physically looking at a chart? And that's why the fundamental traders usually have a big struggle becoming profitable, because they also have to implement technical analysis for it to make some type of sense. So these are going to be the 3 different types of market approaches that you can decide to trade the market in. And for the remainder of this video, we're going to simply and solely only focus on price action trading, because it's what I have been using to become successful. And it's what 99% of the traders at the end of the day have to come back and trade, because you need to
know where you're going to place your entry point, your stop loss, your take profit, so on and so forth. And don't worry, I'm going to get into a lot more detail on what these terminologies are. I just need you to know exactly what we're going to be learning so you can learn these terminologies with the type of trading that we will be doing. So now comes the official first step of technical analysis and price action, which is going to be trend. And now let me just say this right now, and you guys can literally get a sticky note and write this down. The trend is your friend. The faster you know this, the faster you will become successful. And I wish I paid attention to this at the beginning. If I would have done this at the beginning, it would have saved me so much time, so much money, because I wanted to be that guy that went against the trend. And if you were to just think about this outside of trading, when you think the trend is your friend, the first thing that should come to your mind is the ocean current. If the ocean current is going east, you simply swim east. If the ocean current is going west, you swim west. If the current is going west and you want to swim east, you're gonna have a really hard time. If any of you guys have ever been out to the ocean and swam against the current, what ends up happening is that you simply don't move. You stay in the same exact spot. You stay in the same exact spot and you have no success. Well, that is exactly what happens with the market. But when you go with the current, you make money. And when you go against the current, you lose money. When you go with the trend, you make money. When you go against the trend, you lose money. The trend is your friend. This is the number one thing that you need to know. And it is the most important thing when it comes to my trading strategy. And it just happens to be the first thing that we're going to be talking about when it comes to technical analysis. So now, how do you identify a trending market? It is very simple. So as you guys can see, if we come over here to the chart, you can identify a trending market by looking like this. You can simply tell this is a market heading to the upside because it is clearly heading to the upside. And then you can tell this is a trending market to the downside because you can clearly see it heading to the downside. So this right here is a bullish market. And then this is a bearish market. This is a bullish market right here. And then this is a bearish market. So bullish means buys or up. Bearish means sells or down. And this right here is consisted of different types of words that make it a bullish market or a bearish market. And this is going to be higher highs and higher lows. So let me just type it in. So I need you guys to understand these principal rules right here of identifying a trend. And this is that a bullish market is obviously buys and means that the market is heading to the upside. And this market is consisted of higher highs and higher lows, which is a short abbreviation is HH, which is higher high, and then higher low, which is abbreviation for higher low. So then a bearish market is obviously for sells and indicating that you're going to the downside. And this is consisted of lower lows and lower highs. Obviously the abbreviation for LL is lower low and the abbreviation for LH is lower high. Now I want you to remember it is impossible to have a bullish market without a higher high and higher low. And it is impossible to have a bearish market without lower low and lower highs. It is absolutely impossible. Same way how it is impossible to have a ocean current going east without the waves creating the crevices going east. And it is impossible that the ocean current is going west without the ocean crevices going west. It is the same exact thing. And this is how you identify whether the trend is bullish or whether the trend is bearish. Now, this is going to be very important that you understand this, because when you mark off the higher high and higher low, which I'm going to show you in just a second, you're going to be able to tell when the trend changes from bullish to bearish or from bearish to bullish. But the only way for you to be able to identify that is if you can identify the higher highs and higher lows. So let me explain. Higher high should be very self-explanatory, and that's pretty much going to be the highest high point. So that is going to be off of this point right here, and we're just gonna double click this line, we go to text and we simply just type HH inside of this box right here, which is going to be the abbreviation short for higher high. So we know that this is the higher low. And where is the higher low? Well, it's the last higher low, which is going to be this point right here. So I'm simply gonna copy and paste this line. We come here and we click and adjust as a higher low. Now we understand that this market is bullish because of this higher high and this higher low. It is impossible to have a bullish market without a higher high and a higher low. And if we were to have our bearish market, obviously the lower low would be the lowest low point, which is this one right here. Simply double click it, come into the box, and we're going to put lower low, which is the abbreviation for right here. And then for the lower high, we're just gonna copy and paste this line, put it at the last lower high, which is at this point right here. And we're going to put lower high because it's the last lower high. Now, obviously I'm gonna explain now how to identify these points and how it gets a lot simpler. But so you have an idea is picture the last move of the market as the last wave before it hits the shore. That is where you can start counting the amount of waves that the ocean is showing you within the vision that your eyes can see. So if I were to simply come over here and show you at a picture example. So as you guys can see in this image right here, the last wave before hitting the shore would be this one right here. And you can pretty much count the following waves that are going to be hitting the shore. So this is the first wave, this is the second wave, this is the third, and then this is the fourth wave. So this wave right here has the highest point of the wave, and then it has the highest low point of the wave. This is where you can pretty much measure and identify how close the wave is from hitting the shore and how close the wave is from the last wave. It's a way for you to tell where is the highest point of the wave and where is the highest low point of the wave. Obviously in this example of the market going to the upside, and then we just simply flip it over vice versa for it heading to the downside. So we know that this is the closest wave to hitting the shore. So when we go back to the charts, this is the closest market structure trend to being at the live price. So now that we understand that it is impossible to have a bullish market without a higher high and higher low, and it is impossible to have a bearish market without a lower low and lower high, let's just remove this, right? So we can focus on what matters, which is the trend. So let's say this market creates something like this and it does this. Well, this means that this market has clearly now created a new higher high. So we have to adjust our higher high to the new highest high point. And then the higher low, we have to adjust to the newest higher low point, which is going to be this point right here. And then this market can pretty much do this forever as long as it continues to go to the upside. And this market will remain bullish as long as we remain within the higher high and higher low. Meaning this market is bullish permanently forever until we are above the higher low point. The moment we close under this line and the market does this, we have now shifted the trend of the market. So now this market is no longer bullish. Now this market is bearish. There has been a change in the trend. There has been a change in the current. I'm sure we're all familiar when we've been at the beach. Sometimes the waves are coming to the east and sometimes the waves are going to the west. And if you guys have been at the beach long enough, if you go early in the morning, the waves are going a certain direction because it's getting the overnight current. But then towards the afternoon, when it comes to sunset, the waves are now going in a completely different direction because the current has changed. Well, this is exactly what happens in the market. The market could be going to the upside and then it can change to the downside. And the way you can identify the trend shift is by these higher highs and higher lows. And this is how you can understand where the trend is going, if the trend is going up or if the trend is going down. And then this right here will be pretty much the same exact thing when the market is to the downside. As long as this market stays in between the lower high point and it does this, this market will continue heading to the downside, and this will turn into the new lower low, and then this will turn into the lower high. The moment we close above that lower high, this market has now changed from bearish to then bullish. So then this will become the new highest high point, and then this will become the new highest low points because the market trend has now shifted. And again, I'm going to get into a lot more detail in this later into the video. I just want you guys to understand how to spot a trending market. Now, these trending markets are in absolutely every single pair in the market, every single time frame, everything, right? They come in all different types of shapes and sizes. Same way as the currents in the ocean. Whether you see big waves or whether you see little waves, whether you're looking at a very small section of the ocean or whether you're looking at the whole entire ocean, there is currents all throughout the ocean. There's the overall currents from the Pacific Ocean, and let's say that can be going west. But when you zoom into that section within the Pacific Ocean, you can have variations of it going east, north, south, west, however the wind is taking it at that point. So it just depends on what section you're looking at that will identify what way the current is looking. And to explain this now in the trading market, a currency pair Euro USD, which is like the Pacific Ocean, depending on the time frame you look at it, the trend can be going north, south, east, or west, or it could be going bullish or bearish, right? There's no north, south, east, or west in trading. It's only going to go up or it's only going to go down. So it's actually a lot easier to identify if a pair is going up or down than seeing if the ocean, what way the current is taking it. So now the trend itself is actually consisted of something called market structure. Now, market structure is pretty much like the crevices of the actual wave. So if we go back to the image over here, you can see that this wave is built because of these crevices and these bubbles and what creates the wave, which is the details of it. Well, it's the exact same thing when it comes to the actual trend of the market. The market is built off of details, and those details are called market structure. And market structure is what we will be trading. And what you're currently looking at is market structure. And market structure is every single point that looks like an elbow, that looks like a triangle, looks like a pointy thing, however you want to identify it. Every single point that looks like this is consisted of market structure. And as you can tell, the market is heading to the upside or heading to the downside because of these market structure points. This is where it identifies where the market has had a rejection from that point, whether it's to the upside or whether it's to the downside. Let's say this market right here decides to then do this. That has now created a market structure point. This, as of right now, is not a market structure point. Why? Because it has not created the actual market structure point. This right here can simply continue heading to the downside, and then from here, it decides to then do this. Well, now this is a market structure point. Not these points in the middle where there is no elbows, where there's no triangles, where there's no pointy sections. That is not market structure. That is just price action. Price action is just the price going up or price going down. Now, when price goes up and when price goes down, it leaves a trail. And that trail is consisted of market structure. And every single point the market has a reversal point is a market structure point. Same thing from here when we are headed to the downside. Every single one of these points are going to be market structure. Not this zone right here in between. This is not market structure. 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 Market structure are these pointy elbows that the market has had a reversal, indicating that it is going to continue to the downside or continue to the upside. It's wherever the market has had a reaction from. This is going to be very, very key because we're going to be entering trades off of market structure. So if you're tired of me saying market structure, just hit the subscribe button. because I think I said it 100 times. And the reason why I said market structure point so many times is because it's going to lead us to our next point, which is going to be support and resistance. So now remember, support and resistance, if you were to think about it, having nothing to do with trading, what does that mean? Well, if I were to want to push off of this table, I'm using this table as support to then go to the upside. If I want to pull myself down, I will use the bottom of the table as a resistance area to then push myself down. So you are using support to push yourself up, and you're using resistance to push yourself down. Well, this is exactly what the market does. The market uses support points to bounce and head to the upside, and then it uses resistance points to reject and then head to the downside. If you're buying, you're using supports. If you're selling, you are using resistance. Resistance is to go down, support is to go up. If you're going up, you're buying. If you're going down, you're selling. And this is very simple because an area of support can be used as resistance, and an area of resistance can be used as support, just as how I use this table. I use it as support to push myself up, and I use it as resistance to pull myself down. It is the same area, and I use it as support and resistance. So if we come to the market now and we were to identify a chart, we would come here and we can simply see that a support level would be where the market has had multiple rejections from. So this right here would be a level of support, because you can see this is a zone where the market has rejected multiple times from. This is a level of support. And then this level right here, clearly the market has rejected multiple times, and this is a level of resistance. Now, keep in mind, it's never going to be perfect right to the T. Obviously, the market moves in candlesticks, so you're gonna probably have a little bit of margin up, margin down, but we'll get into more details there. But level of support is where price has rejected from the bottom to push itself up, and then resistance are where price has reached the roof and has used it to push itself down. So for example, if price were to be here right now, it would use it to then push itself down, and if it were to come to this point, it would use this point as support to then push itself up. So this is a classic level of support and resistance. And this is extremely important that you understand what is a resistance level and what is a support level, because we are going to be entering our trades off of a support or off of a resistance level. As if I were to have to push myself up, I would need something in order to push myself up. I can't just push myself up out of thin air. I'm not Superman. I don't have those powers yet. I need a platform to push myself up. So I need to identify the platform that could withstand my weight to push myself up. If you're looking to buy a trade, you need to identify a strong level of support that is going to withstand the market and push your trade to the upside where you're looking to buy, where you would make money. And this leads me to my next point, which is going to be area of interest, or also known as a level of supply and demand. As you can just see, I've identified this table as an area of interest where I want to use it to push myself up or pull myself down. This is my area of interest, what I'm going to be using. Now, this is exactly the same thing that you will be looking at the markets when you're looking to buy or when you're looking to sell. An area of interest is an area that you want to identify strongly to go up or strongly to go down. So if I were to show you right here when we come back to the charts, you can see that if I were to be having this spot right here, price having a pullback, I would identify this as an area of interest, because every single time we come to the zone, we are rejecting and we're going to the upside. So I would place a buy here. And if the next time we come to this point right here, I would use this as an area of interest because we have clearly rejected it multiple times, where I'd be interested in selling it to the downside. Now, the only way you can identify an area of interest is if you have a minimum of 3 market structure rejections. So this right here is a perfect example of an area of interest because we have more than 3 market structure rejections. As you can see, this right here is a market structure. This right here is a market structure. And then this right here is a market structure. So if we were to come back into this point, this is a valid area of interest. Same thing if we were to come here as resistance. this would be a valid area of interest because we have more than 3 touches from this level of resistance, which would be qualified as our area of interest. So an area of interest has to have more than 3 touches to be a valid area of interest. A minimum of 3, anything above 3 is obviously better. The more, the better, because it means that it is more respected. So when you're going to use this as an area of interest, it's going to work to your advantage a lot better. So you want to make sure that you're using the current price as an area of interest. So for example, let's say if you were to have the chart like this, and if you were to only have these two and you would not have this and you wouldn't have any of these, you cannot use this as an area of interest because it only has 2 touches. It does not have 3 touches. This is a touch as a support level, but since you are at a resistance level, you're interested in selling, so you need 3 touches of the resistance level to then enter the trade. You can't use a level of support to add as 3 touches. That simply just makes no sense. You want to make sure you have 3 touches of the resistance level in order to take the trade. If you don't have 3 rejections previously, you simply don't have a valid area of interest. Even where price is right now is not considered a rejection because we don't know if this has rejected it. We're looking to enter the trade before it does. So if this were to do this, this is a valid area of interest now because this is the 3rd tap. So this is what an area of interest / supply and demand consists of. It consists of an area that has more than 3 touches of market structure. Next is going to be round psychological level. So make sure you guys pay attention because this is actually the easiest one and it's the most straight to the point one. When you think round psychological level, the first thing that should come up is a round number. So every round number is going to be every 100, 200, 300, 400, 500, 600. It's every round number to every 100th. So this is exactly what we look for in the charts because the markets have reactions from these round psychological levels. Think about it. Let's say you were to be an institutional bank where you are moving trillions of dollars every single day. Do you think that you would decide to liquidate your positions at a random price point on the chart? Let's say 1.5321. No, that's not ideal. You want to liquidate your positions at a round psychological level. So all your positions are closed equally and you have everything organized. So you would close your position at 1.5 thousand. That is a round psychological level. Or you would close it at 1.5500. Something that is a round level and that all the positions can get liquidated at the same exact points, and you can keep it on your books and you don't have just a random number out there on the charts. So round psychological level on the charts are actually very easy to identify. All you have to do is get your horizontal line and you can simply just throw it wherever in the chart. And you double click it and you will go to coordinates. And when you are in coordinates, you simply round it to any 100. So for example, this is 1.77102. Do you want to round this off to 1.77100? So you would round it off to the 100th and you would simply click OK. And you can see how now it pops up on your chart as an identified round psychological level. You can come here, throw it another again randomly into the charts. You would go to coordinates and you can see here how we have 1.76805. So you would erase the 5, you would put a 0. Now you have a round psychological level, 1.7800. And you can pretty much just do this on every 100. It's very simple. It's almost kind of fun. 1.76353. So you want to round this to the 100. So obviously this is above the 50 mark. So you were to round this off to the 400. Or if you want to round it off to the 300, or because where you placed it, it was above 50, you can then round it off to the 400. The point is that you need to have it closed at a round psychological
level. It is every round number. You don't want to have a bunch of random numbers. You want to keep everything very clean, very straight to the point. So now that we understand round psychological level, the next subject is going to be the Japanese candlesticks. So Japanese candlesticks is what we have been looking at in the charts. There are these candlesticks, these boxes that they're blue or green when going up and red when going down. This is very important because these are the candlesticks that we will be trading when you're looking at price action, when you're looking at the market trend. Everything is going to be based off of these candlesticks. So it's very key and very important that you pay attention to how these candlesticks work. So let me explain to you how these candlesticks work, because these are the candlesticks that leave the trail on the charts, that leave the footprints, leave the patterns. This is everything that we will be basing our trading strategy on, and how you're going to execute trades on the market based off of these candlesticks. When you have these candlesticks all accumulated, and they create a trading strategy. So if we look at this image right here, this is what a candlestick consists of. Candlestick consists of a high point, consists of a close point, an open point, and a low point for a bullish candle, and then a high point, an open point, a close point, and a low point for a bearish candle. So every single candle has to open and then it has to close, and every single candlestick has a high and has a low, or a low and then a high. It's the same exact thing, just one is bullish and one is bearish. So as you guys can see right here, this green box is called the actual candlestick. This is where price opened, and this is where price closed. Now this can be the 1 hour, the daily, the weekly. This candlestick that we're looking at can be in absolutely any time frame, because every single candlestick is the same. The only thing that changes is the actual time frame, but what the candlestick consists of is the same for every single different time frame, and we just discussed the time frames earlier in this video. So this high price is the trail of where price was. So this candlestick, well, this box was actually up here at one point, and then price was pulled back, and that wick is the trail of where the price was. So this is where price had pushed up to, and then price came back and it closed at this point. So as well, from this point, when price opened, price actually pushed to the downside, but then the buyers came into the market and then pushed the price to the upside. But this is where the price closed, leaving a wick on the bottom and a wick on the top. The wick is pretty much a different term as used for trail, because let's say that I were to be at the beach and I were to get a stick and I simply move the stick up on the sand and then I move it down. You guys can see that there is a trail that I left with the stick, but where I last leave the stick, that's where the stick stays. Well, that's when price opens, it goes up, it leaves a trail, and when price goes down, it leaves a trail as well. And where the price last closes, well, that's where price stays. So these wicks on the high or on the low is the trail that the actual candlestick has done within that hour of whatever time frame you are looking at. So let me actually just show you in the charts right now. So this candlestick right here, which is the last candlestick, this candlestick had opened at this point right here, and then price had been pulled down just a little bit, and then price was pushed all the way up to the upside to the high of that wick. Then a little bit of sellers came, and then this is exactly where price has then closed. So when the next candlestick opens, it is going to open like this. It's going to open where this price was closed at last. And let's say as soon as it opens, it decides to go to the upside, but then it decides that the sellers are stronger and it's going to push down. It simply can't just like this because the price actually pushed up. So it's going to leave a wick at this point right here. And this is where the price was at. So if price pushed all the way up to this point and then it pulled back down over here, then that is the trail that this price leaves. And if this keeps pushing down to, let's say, this point, and this is the lowest point this candlestick made, but then it decided to pull all the way back up to here, well, it's going to leave a trail, which is the wick,
that the price made it to that low point when it was fluctuating. So this candlestick would have done all of this within the daily time frame, meaning it decided to move up all the way to this point, low all the way to this point, and then close at this point within 24 hours of this candlestick. And then let's say the next one, it opens where this one closed. So if this one closed at this point, then the next one will open here, and let's say it goes a little bit to the upside. So then this would be the highest point it was. And then let's say it just decides to push down, it will leave a little tail right here. And then we will continue to then head to the downside. And let's say it goes all the way up to this low point, and it decides to have a little bit of a pullback to, let's say, that point right there. Well, then this would only have a wick this size, like right there. And then if the next candlestick opens where it closed, if it closed here and then it heads to the upside, but first it did a little bit like this, well, then it would leave a little bit of a wick to the downside at this point right here. And then if it closes to the upside, let's say it went all the way up to this high, that's the highest point that candlestick made, and then it decides to have a pullback to this point, well, then it will leave a wick right here, which is going to be the trail that that candlestick has left. So basically, when a candlestick opens, it's going to push up or down, and wherever it decides to go, it's going to leave a trail, which is going to be the wick. So now that you understand how the candlesticks work when they open and when they close and the trail that they leave, it leads me to my next point, which is going to be candlestick patterns. So this is where you have a mix of the actual candlesticks and then price action where they create a pattern in the markets. These patterns are used as continuation patterns. They're used as reversal patterns when you're taking a trade. You're going to add this as a confirmation or another reason to take a trade because you're seeing this pattern happen time and time again. And these patterns will identify if it is a trade continuation pattern or if it is a reversal pattern. A trend continuation pattern is pretty much what it says in its name. It's a pattern to indicate to you that the trend will continue to go in its favor. And then you have a reversal pattern, which is a pattern that it's going to indicate to you that the market is now going to reverse. Whether you have a market at a high that is going to indicate to you that now the market is going to reverse to the downside, or a pattern at the bottom that it is going to indicate to you that the market is going to now reverse to the upside. Or if you have a trend continuation pattern, it's a pattern that if the trend is going up, it's a pattern that will indicate to you that it will continue to going up. Or if you have a trend continuation pattern to the downside, it's a pattern that's going to indicate to you that the trend is going to continue going to the downside. And this is very important because if you're looking to trade with the trend, you want to trade with the continuation pattern. And if you're looking to trade against the trend, which I don't ever recommend, you're going to use the reversal pattern. Or if you see this pattern, you know not to take a trade if you're trading with the trend. For example, let me show you the most effective and my favorite reversal pattern in all of the market, and you'll see how often you can actually see it in the charts. And it is going to be the head and shoulders pattern. So as you guys can see right here, this pretty much looks like a head and shoulders or three peak mountain, whatever you want to call it. The actual proper terminology is head and shoulders. As you can see right here, this is a left shoulder, this is a head, and then this is a right shoulder. And if you can see, all of this is an accumulation of both of the important things that I have taught you. One, market structure, and two, candlestick patterns. So as you can see right here, this peak, this elbow, this pointy point, this triangle, this is a market structure point. This is a market structure point. This is a market structure, market structure, market structure. And as you can tell, this market structure created with the candlesticks has created a head and shoulders pattern. So if you see a head and shoulders pattern at the top of a trend, this is a reversal pattern. This is going to indicate to you that now the market is going to head to the downside. So the market is no longer bullish. If you see the head and shoulders at a resistance point and at a high point in the market, this is an indication that the market is now going to reverse. So if you were looking to enter buys, you should no longer enter buys because you're having a reversal pattern.
And then its brother or its sister is going to be the inverted head and shoulders, which is literally the same exact thing, just opposite. So an inverted head and shoulder happens at the bottom of a trend where you will have the same exact left head and then right shoulder. This is where it's consisted of market structure, market structure, market structure, market structure, and market structure with the candlesticks that I have just explained to you, and it creates an inverted head and shoulders, which happens at the bottom of the trend. And as you can see, when the formation happens, the market now heads to the upside because this is a reversal pattern. And it's very important for you to understand these patterns because they happen time and time again in the market. And this is a way of you creating an edge because you're seeing the same thing happen time and time and time again. So you use that to your advantage. Imagine if you were to be a surfer, and every single time you were on the beach and you were about to surf a wave, you would see a certain type of wave come from a distance, and it would have a certain crevice at a certain speed and a certain height. And every single time that happens, you ride a beautiful wave all the way to shore. So when you see this happen time and time again, you know to get ready to be out there in the water and for you to be able to take your wave all the way to shore. This is an indication that you're going to have a great wave. This is the same exact thing. This is a great indication you're going to have a great trade because the pattern happens time and time again in the market. And these patterns happen on all different time frames. They can happen on the higher time frames. They can happen on the lower time frames. Just keep in mind, the lower time frames, it's not going to be as respected as the higher time frames. Same way as surfing a wave. If you have a little wave, you're not going to get that far versus if you have a bigger wave. The bigger the wave, the longer the ride, the shorter the wave, the smaller the ride. So the smaller the time frame, the less respected it is. The higher the time frame, the more respected it is. Now, I have a video where I actually explain all of the patterns that I use every single day when I trade in order to actually enter a trade at this head and shoulders pattern, at a reversal pattern, so you can use it to your advantage. So make sure you click this video right here and you learn from the actual patterns so you can take an advantage and go into a little bit more detail on how they're used and how I've been using them for the last 6 years. Yeah, and like, as you guys can see, that right there is literally a head and shoulders pattern right there. Literally a head and shoulders right there. And you can see how that happened at the high of a market, and it was a reversal pattern heading to the upside. And that also says right there to hit the subscribe button. Subscribe. Why you're this far into the video and you're gonna not subscribe? Really? Really? So now that we understand that, our next topic is going to be indicators. So a lot of traders have a fantasy indicator, 100% win rate indicator that will indicate to you when to enter the trade, when to get out. It's going to do all the work for you, blah, 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 blah. This does not work. An indicator is simply an indication. It's never going to give you 100% guarantee that the trade is going to go in one direction versus the other. It's almost like the weathermen at the news. They can give you, they have an indication that it can possibly rain at noon and it might be partially cloudy, but it's never 100%. Sometimes it works, sometimes it doesn't, but they have an indication based off of science and the research that gives them the forecast of what will be happening with the weather. What's the exact same thing with an indicator? An indicator gets all of this data from the price, and then it will give you a forecast whether it's going to go up or whether it's going to go down, depending on how you use it. So an indicator is simply something that is going to give you an indication whether it's going to go in your favor or it's not going to go in your favor. It's just going to give you an indication of where the market is going. So keep in mind, the more indicators does not mean the more probability your trade's going to win. If anything, the more indicator means the more complicated you're getting your trade in, because you're putting more things into the charts than you actually need. You don't need to have a bunch of different indicators telling you if the market's going to go up or if the market is going to go down. You simply just need one that works, because one indicator can be predicting long-term market movement, while another one can be predicting short-term market movement. Same way as the forecast with the weathermen. Some indicators can be predicting if it's going to rain all of summer, And then some of the indicators can predict if it's going to rain tomorrow. So you don't want to accumulate all of these different indicators to decide if you're going to go to the beach on the weekend. You want to make sure that you're focusing on what matters, and it's what's happening right now. So getting over here to the charts, and these are the most standard indicators. So an indicator, when you see it on the charts, it's basically a dynamic level of support and resistance that the market creates based off of the market movement. It's going to be moving with the market simultaneously when it's going up, and it's going to move simultaneously when the market is going down. Wherever the market goes, this will simply follow it with a space in between, because it's going to give you an indication if it's going to continue going down or if it's going to continue going up. A lot of traders use the indicator whenever it's above to buy or whenever it's under to sell, but it's not that easy. It actually goes into a lot more detail than that. So as you guys can see in this image right here, this is how you don't want to look when you're trading indicators. People go absolutely nuts thinking the more indicators that they have, the more money they're going to make. And as you can see right here, you can't even see the actual price. You can't see the candlesticks. You can't see anything because you have so many indicators in between price that you can't even focus on what's going on. So you do not want to have your chart full of all these indicators. And now I can go on for hours about indicators and how all of them work. But the reality of the situation is that they all do the same thing. They just give you an indication if it's going to go up or go down. Now, there's no holy grail of indicator that works. There's only one that I have tested, and I've tested thousands of these. There's only one that works. Everything that you see with these other indicators, they will probably have the same exact win rate or loss rate, or they give you the same exact edge, but they're just so much more complicated to learn, and they are simply waste of time. I wish that I would have learned this at the beginning, because I would have saved myself endless hours of applying these indicators, back testing, live testing, when it did absolutely nothing. Because literally, this is like having the Forex Factory that will indicate to you the news. You can read as many news as you want. You can literally be a you can literally be right there as soon as the news come out, but you will still not be able to use it to your advantage because you don't know what's going to happen in the news. It's the same exact thing with this. You can have as many indicators, the best one, but it simply will never give you exactly what you need. The simpler, the better. Now, many of these indicators can be like EMA, which is short for exponential moving average. It's just a moving average that goes exponentially with the price. It's very self-explanatory. Next is the RSI. So RSI will indicate to you when the market is overbought or when the market is oversold, basically indicating to you that if the market is oversold, it's a great time to buy, or if the market is overbought, it's a great time to then sell because price is too high or price is too low, which we all know that the market can never be too high and it can never be too low. So the RSI indicates to you that it's too high or that it's too low. Obviously that doesn't work well. And we also have Bollinger Bands. Bollinger Bands is pretty much bands that trap price as it goes up and trap price as it goes down. And whenever the price hits the top of the Bollinger Band, you should sell. And whenever price hits the bottom of the Bollinger Band, you should buy. As well, it's a very delayed process. It doesn't work, and it just simply makes your chart look very ugly. So to summarize, you don't need any of these. They're very excessive, they're delayed, they don't work, and they simply complicate your trading. An indicator is cool, but it's not the holy grail. So stop getting shiny object syndrome and getting clickbaited into one of these videos saying that they have the best indicator. I am here to tell you that you do not need that to succeed, and it will simply not work. I have tested it out. I have done as many research as I can. I've even tried to automate this and put money behind the research on a proper indicator, and it simply doesn't work. The next topic that I want to get into is going to be Fibonacci retracements. Now, disclaimer, I do not use Fibonacci. I have not used it since I began my trading journey, and I have not used it at all to become successful. I just feel like it's good for you to know what it is, so when you hear about it, you're educated, but I want you to know that you do not need this to succeed, and you do not need this to make money in the markets. This is the same thing as an indicator. later. It is very delayed, it's very fugazi, and it does not work, and you will have no use for it. But I think it is important that you should know what it is, so you're just simply aware of it. So Fibonacci itself actually goes back many years, and it is a mathematical equation where it's a sequence of multiple numbers getting added up, where you can pretty much predict certain movements in the future. It goes into a very spiritual depth. And some traders created that mathematical equation and then created a tool, which is the Fibonacci retracement. And the Fibonacci retracement pretty much indicates to you how far back the price can then pull back to then head in a certain direction. Now, this is extremely subjective because you can throw the Fibonacci tool many different ways, and there's not a certain way you should, and there's not a certain Fibonacci number that you only take the trade in. They put many different zones to take a trade, so it is extremely subjective, and I personally have no use for it, and it makes absolutely no sense. Let me explain. So as you guys can see right here, this is a Fibonacci retracement. So this is a bullish market heading to the upside, and then we are expecting for price to have a retracement to then go to the upside. As you can see right here, this is the beginning of the Fibonacci, and then this is the ending of the Fibonacci. This is the retracement that we are anticipating for the Fibonacci to happen to either the 50, the 32.8, or the 23.6. And then we will then have the push to then the 1.68 into the 161.8 as our take profit. Now, this is extremely subjective because you can throw the high to the wicks, you can throw it to the bodies, you go from wick to body, body to wick. It's just simply complicated. And if you notice, there's multiple zones you can anticipate the pullback to come in. You can anticipate the pullback to come here and then go to the upside, go to the second zone and head to the upside, or go to the third zone and head to the upside. So how do you know if you should enter the trade here, here, or here? So they pretty much set 3 different zones for you to enter the trade. It just simply doesn't make sense. Fibonacci retracement is pretty much when price is having a pullback. You just simply add the Fibonacci to add a confluence, but it makes absolutely no sense. And all of these numbers, they come automatic when you go to TradingView. So if we come here to TradingView, and if we were to come over here to the actual pattern section, you can see how we're going to have a Fibonacci retracement. So right here you see Fib retracement, and you can start it from this point all the way up to this point. And this would be interested for a buy. So as you can see, we would pretty much have this area right here. We'd have a Fibonacci retracement, and then this is what we would anticipate. Simply makes absolutely no sense, and there would be absolutely no use for this ever. If I were to show you an example of how they use the Fibonacci, they would simply grab this tool, and I almost have like cringing like using this right now because I haven't used this in so many years, but I'm just literally doing this for you guys so you guys can understand. So they would throw it from the wick point right here, and then they would drag it all the way up to the high of this wick right here. I'm just going to move it to the right so you can see the numbers. They would say, okay, yeah, this had a Fibonacci retracement to the 50%, and then it headed to the upside, and you can see it hit the take profit perfectly at the -27. Makes absolutely no sense in my opinion. Like I can't believe I just did that. That goes against my whole trading philosophy. I do not watch this back. I hate this that I'm explaining this. I'm just doing it for you guys so you guys are educated and you guys don't waste any time. I wasted a whole 1.5 years trying to figure out how I was going to become a mathematical genius using this. It did nothing for me. And what I just showed you guys was a winning example. Everything will work with a winning example. I can show you all the EMAs that work after it already happened, but in real life trading, this doesn't work. Now moving on to the next topic, and that is going to be back testing. So back testing is very commonly used as beginner traders because you want to back test that your strategy or your theory works. It's pretty much a freebie to see if you can make money with this in the future. So you're using the previous price data to see if you can make money with the future price data based off of what you back tested in the past. And this is because history tends to repeat itself very often in trading, and not only in trading, but pretty much in life as a whole. Like, we backtest every single day without even noticing. As simple as when we go through traffic every single day. If we know yesterday there is a certain section when you're going to work or when you're going home that the road is closed, well, you backtested that yesterday, so now when you're gonna do it in the future, you're gonna go around that area to somewhere else. For example, it's when you want to go somewhere and it's traffic hour. You know not to go somewhere at a certain time, or you simply can't go somewhere at a certain time because there's traffic. How do you know there's traffic? Because you've back tested it, you've gone through the live market, you've been through the traffic. So you know that if you want to go somewhere when it's rush hour, it's going to take you a really long time and it's going to be a waste of time. So what do? You set yourself up for success by knowing when the traffic is going to happen. You then only go do things when there is no traffic. So the same thing happens in backtesting the trades. You backtest what is going to happen and then you use that to your advantage. So when you are looking for something, you know exactly what to look for in the future because you have just backtested it. So the way you do backtesting in TradingView is actually very simple. So you would come here and you would click this replay button. So as soon as you would click the replay button, this blue line would pretty much pop up on your screen that you can go back pretty much as far as you want, and you can cut price off wherever. As you can see, there's scissors right here, and if I were to click it, the section that is in the lighter color would disappear, and then the section that is in the darker color would then stay, because this is the section where we would start the back testing from. So let's say I would click from this point right here. I would click it, and now I have erased all of the price that has just happened. So let's say I want to put to test certain type of candlesticks, certain types of patterns and rejections. I would pretty much build my trading plan based off of that, and then I would simply click play on exactly what would happen. So let's say right here I would anticipate a break and then a retest pattern to head to the upside. Then I would use that to my advantage so I can see if this pattern will then happen. I see a break, I see a retest, previous structure point, round psychological level, and then you would play, and then the trade would play out. This is how you can see the patterns happen time and time and time again. Now, I personally do not recommend backtesting at all, simply because I think it is a very easy way to create an illusion of how fast the trades can play out. Because if you just notice what we just went through right now, if I were to use the measuring tool, we just went through 11 to 12 days worth of price in literally 2 seconds. And the psychology of a trader that has to hold a trade for 12 days is not going to be the same psychology of a trader that just backtested for 2 seconds. A trader that just backtested for 2 seconds and the trade played out that fast is going to think that that is exactly how it's going to happen in the live market. And that is not how it's going to happen. You have to wait 12 days, meaning it's almost 2 weeks from the moment you take the trade. And that requires extreme amount of patience. And backtesting to me is pretty much damaging your self-confidence and damaging your psychology, even though it's supposed to make it better. But what you're doing is you're creating an illusion of how the market should play out in terms of speed, because you're seeing how the market is going to play out in terms of technical analysis, and that is cool. But when it comes to speed, that is what traders struggle with the most, waiting for things to happen faster than they should have. And that is because trading is 80% psychological and 20% technical. That's the stat that the big institutions say. I think it's almost 95% psychological and 5% technical, because when you learn how to read the charts, it's like learning how to read a language. Now, the actual challenge comes when you go to speak this language to somebody else. How confident are you if you just learned a new language that you can go speak with it fluently when you go on a date with a person? All of that is psychological, because you don't want to obviously look like a fool. If you're going on a date with a pretty lady and it's your first time speaking Japanese, you want to make sure you can speak Japanese to the best of your capability. So this happens the same exact thing here. You can learn how to read the candlesticks, but then your psychology is not ready to then wait 12 days for a trade to then play out. If you're a beginner trader, this won't make sense just yet, but as you continue your path as a trader, you're going to remember this that I'm telling you right now. So now that we understand, let's move on to the next topic, which is going to be more hands-on. It's going to be the section that I want to call how to actually take a trade, or the principles that you need to know and understand to actually take a trade in the markets when you're trading any single pair. So there's multiple things that you need to know before entering a trade and even realizing, is it time to enter a trade? Where are we? What's going on, right? So the first things first that you need to know is how to measure your trade. And measuring a trade is measured by pips. So I'm sure you've heard me say this word, many times throughout this whole video, and you're probably wondering, what the hell is this word pip? And for some reason, a lot of traders just get confused at this word pip, right? It sounds like it's something small, and it actually is. Pip is the points in percentage on how you are going to measure the currency pair when it goes up or when it goes down. So pip is an abbreviation for point in percentage. This is basically how you're going to measure the points in percentage if the currency is going up or if the currency is going down. It's like saying units, or it's like saying cents. Like, let's say the dollar is trading at 1.501 and it goes 1.508. It just went up 7 points, 7 pips, 7 units, all the same thing. Well, not the same thing, but it's all a different type of measurement. But the way we measure is by pips. If a car were to move forward several feet, let's say 100 feet, it is measured by feet, but it just moved forward. You can measure it in feet, in inches, yards, miles, doesn't matter. It's just a different type of measurement. Pip is simply a different type of measurement that we'll be using to calculate our stop loss, to calculate how much a trade has gone up or down, and it is the most common terminology used to measure how far a trade has gone up and how far a trade has gone down, and how to just measure the market as a whole. So now let me actually show you in the chart how you can actually measure with pips, right? So if we come over here to TradingView, this tool that we have spoken about before, which is under the smiley face, you were to click this tool, and as you can see, it is the measurement tool. As soon as you click it, it's going to highlight, and you're going to get the crosshair to have the star on it. So then here you can just click it, and you can drag it to the left, and you can drag it to the right, you can drag it up, and you can drag it down. So for example, if we were to drag this to the upside, as you can see right here, this number to the top right corner is going to move when we go up and when we go down. So as you can see, as we're going up, it's going up, and as we go down, it's gonna go down negative. As you can see here, now it's negative 69. If we go from here and we go up, it's positive 72. This is the amount of pips that this market has moved. This market has moved 72 pips. Obviously, if we were to measure it like this, and if we were to do it to the downside, this market has measured 70 pips to the downside. That's literally it. So for example, if we were to want to measure the size of this red candlestick right here, simply just do a box around it, and this whole entire candlestick is 45 pips. 45 pips to the downside, clearly, because this candlestick is to the downside. If we want to measure this candlestick to the upside, we can measure it right here, and then this would be a 29.7 pips to the upside. Pips is just a different way on how to measure the size of the market, and it's mainly going to be used for the next topic that I'm going to be talking about, which is going to be stop loss and take profit. So for example, in this trade that I just took about a week ago, I'm going to show you how I measured the pips on this trade for my stop loss and how I measured the pips for the take profit on this trade. So if I were to just simply zoom in right here onto this trade, I executed this trade at this point right here, and my stop loss, as you can see, was 15.8 pips, meaning that this was where if I was wrong, the market would have taken me out. And my take profit was 40.9 pips, meaning this is where I want to get taken out of the trade when I am right. And this, I measured it using pips. Very simple, very straight to the point. And you're probably wondering why 40 pips and why 15.8, like is this a specific number? And the answer is actually no.
there's actually a way on how you should place a stop loss and how you should place a take profit. And I'll explain this in just a second, right? So now that we understand what is a pip, let me actually just show you how you can use this to measure your stop loss and measure your take profit, and how to actually calculate how much you're going to risk on your trade. So we're going to discuss all three pretty much at the same time, because as you're entering a trade, all these things are kind of happening at the same time, more or less. So if we were to just bring up a empty chart right here, you guys can see this market is creating higher highs and higher lows. This is a bullish market. And let's pretend like we are interested in buying this trade at this point right here, because this is a level of resistance that we are now potentially going to use as support. When we are going to enter the trade, we have to have our stop loss always about 5 to 10 pips under the area of interest. Make sure you write this down, because this is extremely key to having a proper stop loss and not getting wicked out or faked out, which all of this stuff I'm going to discuss in just a second. But just write this down. Your stop loss has to be 5 to 10 pips within the area of interest. Let me show you. So if we were to enter this trade at this point right here, let's say the market is already having some sort of a rejection from this point, we were to enter at this point, our stop loss has to be under the area of interest by 5 to 10 pips. So if this right here is the bottom of the area of interest, we have to measure 5 to 10 pips from this point right here. So this is where we would bring out our measuring tool, and then we would measure 5 to 10 pips. So this right here would be 5 pips. You can see right here it's minus 5 pips. So we can put a line right there. And then if we were to measure 10 pips, it would be right around this point right here. This would be our 10 pips point. So when we were to take this trade, we would ask ourselves, is it more ideal for our stop loss to be 5 pips from the area of interest or 10 pips from our area of interest? And if you notice, really doesn't make a difference from 5 to 10, because we have still plenty of breathing room. So for this trade, for example, I would have it 5 pips under the area of interest from wherever I took the trade. So this is where I would have my stop loss on this trade. And for the take profit, we have to have the take profit be at the next structure point. So as you can see, this right here is the next structure point, where we can simply have a rejection from, because it's the closest point where there is a resistance level or support level. The take profit is actually the easiest to put, because it's just the first point where market, if it were to have the push to the upside, just the first point that it can have a rejection. Because remember, the market could come into this area right here and have a type of rejection and then have a reversal to the downside. If I were to show you this example to the downside, it's literally exactly the same. And you can see that this is a bearish market heading to the downside. And if we were to be interested in selling at this area of interest, we would have this area of interest right here, and the market is at that point. Now we would place our stop loss entry, our sell entry. And if this market would already have a rejection from this area, this is where we would have to measure 5 to 10 pips above the area of interest. So this is the area of interest, and it is at 2 pips. We would have to add 5 pips, meaning it would be 7, which would be at this point right here. Or if you want to add another 5, it would have to be about 13 pips, which would be this point right around here. And then our take profit would have to be at the closest structure point, which for this example, let's just make it like this. And then this would be our structure point right there as our take profit. So it's very, very simple, because you're measuring your stop loss with pips, and you're just making sure that you have a 5 to 10 pip breathing room above your area of interest if you're selling, and about 5 to 10 pips under your area of interest if you are buying. And you're probably wondering, when is it the right time to pick 5 and when is it the right time to pick 10? Well, simply because, let's say, for example, on this trade, if we were to have an entry, let's say right around up here, and we were to have a late entry, quote unquote, we would want to make sure that, we would have a 5 pip breathing room, simply because we would want the risk to reward to make sense. So this leads me to my next point, which is going to be risk to reward. And this is that you want to have a minimum as a beginner trader a 1 to 2 risk to reward. So let's say you are risking $1, you're going to make $2 for every $1 you risk. Because if out of 10 trades, you lose half of them, literally you are profitable with these 5 winning trades. Because all you need is 3 of these trades to make back all of your losses, and then you have 2 trades that are purely winners. So if you have a 50-50 win rate, meaning out of 10 trades, you lose 5, it's minus $5. But then out of these 5, you win $10. You just outweighed your losses, so you just made back the $5 you lost, and now you just made an extra $5 by simply having a 50% win rate, but a 1 to 2 risk to reward. This is the key to success in trading. And when I figured this out, absolutely everything changed for me, because I realized that I was predicting the market and I was knowing where the trades were going, but I just didn't have the right risk to reward. And even if you win 80% of the time and you don't have the right risk to reward, you will not be successful. You need to have the right risk to reward so your wins outweigh your losses. And the best way to do this is by using pips to calculate your risk to reward. So if we come back over here, we would notice that our stop loss, if we were to have it 10 pips under, our risk to reward ratio, as you can see right here, is not a 1 to 2. We want to make sure that our risk to reward ratio looks something like this. We want to make sure that, see, this right here is not ideal. We want to make sure it has a 1 to 2 risk to reward. So for the $1 that we risk, we make back $2. So in this case, we'd be making back $2.10, which is the ideal risk to reward to start as a beginner trader. And as time goes, obviously you can scale, and the more risk to reward, the better. So now that we understand that we need a positive risk to reward, and we understand that our stop loss has to be 5 to 10 pips under the area of interest, and our take profit has to be at a structure point, this right here is our perfect risk to reward trade that we would want to take, right? This is a trade that makes sense to us, because a trade that makes sense, not only does it have to be a high probability trade setup, it simply has to make sense money wise. Is it worth it to put money at risk here? Yes or no? That's simply all this has to come down to. And you can have all of the confluences in the world, all the confirmations, but if the risk to reward at the end of the day does not make sense, the trade does not make sense, simply because you are risking more than you are going to gain. That is why you need to have a minimum of a 1 to 2 risk to reward ratio. So now that you're ready to enter the trade, you need to calculate how much are you going to place on this trade? What are you going to risk? So for example, this trade, we would here go to my FX book calculator, and we are currently trading Euro GBP. You can see Euro GBP up here, Euro GBP. So we're trading the Euro with the Great British Pound. So we'd come over here to the position size calculator. We would search up EUR GBP, which is Euro GBP. We are going to have our account currency be USD, because I'm currently in the US. And let's say, for example, we have a $10,000 account. Now, what percentage out of this account do you want to risk? Everybody has a different risk tolerance. I always recommend beginner traders to risk no more than 2%. Because if you think about it, if you risk 1%, you literally have to lose 100 times in a row before you blow that account. And let's be honest, it's kind of impossible to lose 100 times in a row. If you risk 2%, you have to lose 50 times in a row. If you risk 3%, now you're at about 20 to 30 times in a row because of spread, so on and so forth, which I'll get into that in just a second. So the more you risk, the more you are prone to blowing your account even faster. So the max I recommend is 2%, because the odds of you losing 50 trades in a row is not likely. And even if you win or lose, you'll be break even at the end of the day because you're using proper risk management. Now, I know it sucks if you have a $100 account or a $500 account or a $1,000 account. I know Trust me, I've been there. Literally, I was working at Dunkin' Donuts and I was depositing $200 into my trading account, and that sucked. But once you learn how to manage percentage-wise on these smaller accounts, then you can take that strategy and that knowledge and go get funded, which I'll explain that as well later in this video. So let's just say for this example, we want to risk 2% on this account. As you can see right here, we are risking 2% of our $10,000 account. And our stop loss, well, how many pips is our stop loss? Well, let's go find out. We come back here to EuroGBP. We click on this tool right here. And as you can see, we have a 9.5 pips. You can round that off to about 10 pips. So we come here. We move it down. We have just rounded it off to then 10 pips. We come to the position size calculator. You click 10, and then the trade and the trade size lot you will always leave at 1. You simply click calculate, and then it's going to exactly tell you how much you're risking on EuroGBP with 2% on a 10 pip stop loss, and that is going to be $200. This is your unit size, and then this is going to be your lot size. So the lot size is actually going to be the actual number you're going to plug in to the MetaTrader 4 or MetaTrader 5 when you're executing the trade. And we're going to be actually executing a trade together later in this video, so make sure you stick around so I can show you pretty much all of this getting pieced together. I want to do one thing at a time so you can understand everything, because if I kind of say everything at the same time, can be very overwhelming. So I want you to understand everything that you need in order to enter a trade. Then after, we will enter a trade together. And for those of you guys that are wondering what is a lot size, well, basically the lot size is the number that you have to put in to MetaTrader 4 and MetaTrader 5 that calculates how much money you're risking of your account. Because you can't go into MetaTrader 4 and MetaTrader 5 and simply put, I want to risk $200. Well, you can't just plug that in like that. There's a mathematical equation based off of your amount of pips and the percentage that you want to risk that comes out with a numerical number, which is this lot size. So it can sound complicated, but this platform makes it very easy. If you have a 10K account and you want to risk $200, well, it calculates to you the lot size that you have to put. It's just simply a requirement that the platform needs in order for it to calculate how much you're risking on your account. So it will do the math for you pretty much. So now that we understand what is a pip, which is a way on how to measure the market, now that we understand what is a take profit, what is a stop loss, which it's pretty much straightforward. Take profit is where you want to take your profit, and then a stop loss is where you want to stop your losses if you're in the losses. And now that we understand risk to reward ratio, which is as well very self-explanatory, it's your risk versus your reward. You want to make sure that your ratio is always a 1-to-2. Now, let's talk about what are the proper time frames that you should be doing this on, right? Which is also called top-down analysis. So let me explain. So the market is done with a top-down analysis, meaning you start from the top and then you make your way down. This is where you're going to go from the higher time frames to the lower time frames to do your analysis. It's called top-down analysis. The simplest way that I can put this is when you wake up in the morning, you are going to dress yourself from the top down. You pretty much brush your hair, put on your contacts, your glasses, put on a shirt, put on your underwear, your pants, your socks, your shoes. Start from the top all the way down. Now, some of you guys probably don't do it this way. I don't do it this way either, but it's just the simplest example that I can put for you guys to understand how you're going to go from the top to the bottom. And then this is where we would be starting our top-down analysis from the weekly time frame. So we would start analyzing the market on the weekly time frame, then we would go down to the daily time frame, then we would go down to the 4-hour, 2-hour, 1 hour, 30-minute, 15-minute. We simply are just going to be going from time frame to time frame lower every single time, because every single time we go lower into the time frames, we get more specific and we get more niche down and more detailed. Picture it almost as if you were to be looking through a telescope, and every single time you zoom in, you're seeing more details on whatever insects or whatever micro that you're looking at through the telescope. The more zoomed in you get, the more details you see on it. Well, it's the exact same thing in the markets. The lower time frame you go, the more details you see on what the market is doing.
So when you're looking through this telescope to your insects or the micros that you're looking at, you want to base your analysis and you want to base your research on this insect or this micro that you are currently inspecting. The more detailed you can get, the detail that you can get into it, the more you can explain. So if you were to go to the lowest telescope, meaning that you can see the most detail in it, you can tell whether it's alive, you can tell how many organisms are inside of it, blah, 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 blah. Now, that would pretty much confirm what you're looking at, and you can write it down and you can use that for your research. Well, this would be the exact same thing. Well, confirm your research, and this would let you know what to categorize this insect or this micro as. Well, it's the exact same thing in the markets. The lower time frame you go, the more detailed you're going to get, the more you can identify your entry signal and what you are looking for in order to actually execute into this trade. And you can categorize it as a great trade, or you can categorize it as a bad trade. But you know this because you are looking down the time frames and you're looking at the best ones. And then that leads me to the next point, which is going to be the famous entry signal, which is going to be, what is the confirmation that I need in order to enter this trade? And this is actually probably the simplest thing for me to explain, and it will have the most effect out of everything. That is going to be, I look for one confirmation to enter every single trade. So if you were to be looking through the telescope at this micro insect, you would be looking for one thing in order to be able to categorize it as a insect, or categorize it as a fungus, or categorize it as a virus. You need one thing to confirm to you what category you would simply put it in. Well, when I'm looking through the top-down analysis, which is our version of the telescope, I'm simply looking for one thing to execute on this trade on whichever time frame it looks the best. And that is going to be a bullish engulfing candlestick if we're buying, and a bearish engulfing candlestick if we are selling. So a bullish engulfing candlestick is very self-explanatory. It's a candlestick that engulfs the previous candlestick, so it's one candle eating the last one when you're going up. And then when we're looking to sell, a bearish engulfing candlestick, which is one candle eating the last candle, but now obviously headed to the downside. Now this is the most effective and the most strongest confirmation that I have pretty much seen and tested for the last 6 or 7 years, and what it has given me 99.99% of my success. Not only because I used it to enter a trade, but because I avoided entering trades that did not have this confirmation. And this is huge, because imagine you zooming in through your telescope and trying to identify where this insect, this micro, is a virus or is a fungus or is an insect, but you don't have the confirmation to do it. You don't have your entry signal. You can't categorize it into something if you don't have that confirmation. So that saves you time wasting putting it into the wrong section. You just simply categorize it as unidentifiable. Well, same thing with trading, but you don't categorize it as unidentifiable. You just categorize it as not a valid trade. A trade that does not have your entry confirmation, you simply do not take. An insect or an inspection that does not have your entry confirmation, you can't categorize it as something because you don't have your confirmation. It's very simple. And what this engulfing candlestick is literally what it is. It's an engulfing candlestick. When something engulfs something, it pretty much eats it. It just completely engulfs it. So to give you a very simple example, you guys can see right here, there's engulfing candlesticks literally everywhere in the market. This right here is a beautiful bullish engulfing candlestick pattern right here. This candlestick clearly ate this candlestick right here. This is a beautiful bullish engulfing candlestick right here. This is also a beautiful engulfing candlestick right here. As you can see, this blue candle has completely eaten the red candle. As you can see right here, this is also a beautiful bearish engulfing candlestick. So you can see this candlestick has eaten these last 3 candlesticks. This one has eaten the last candlestick. This is a bearish engulfing candlestick. It has just eaten this candlestick. This literally happens absolutely everywhere in the market every single day. And it is so effective because it is literally confirming that it is stronger. It is giving you your entry confirmation because it is eating the last candlesticks. It's doing the job for you. It's giving you the confirmation that it's rejecting the area and it's going to continue going in your direction. As you can see right here, this is a beautiful bearish engulfing candlestick. It just ate the last 1, 2, 3, 4, 5 candlesticks. This right here, bearish engulfing candlestick. It has literally eaten the last candlestick. So you want to make sure that the body has eaten and closed above the last candlestick. This right here, bullish engulfing candlestick. Beautiful candlestick has eaten this one right here. This beautiful bullish candlestick has eaten the last 1, 2, 3 candlestick. Bullish engulfing candlestick. Can make it literally, we can be here all day looking at these patterns. This is the most effective and the strongest confirmation that there can be when looking to enter a trade. A bullish engulfing candlestick when buying, and a bearish engulfing candlestick when selling. And to basically make it as simple as it can get is where the last candlestick closes, which would be this one right here. As soon as the next one opens, it just completely goes in the other way. It just completely eats and does the opposite of what the other candlestick has done. As you can see right here, this candlestick closed, this one open, boom, and it engulfed and it eaten the last 2 candlesticks. Very simple. So as soon as you have your bullish engulfing candlestick if you're looking to buy, or your bearish engulfing candlestick if you're looking to sell, right before you click that buy button or right before you click that sell button, you have to take one thing into consideration. The last thing, and that is going to be spread. Now, what is spread? Well, spread is the cost of doing business with these brokers. It is absolutely inevitable. You're not going to get around it. It is impossible. If you want to take a trade in the market, you have to pay spread. And if you want to drive your car on the road, you have to pay tolls. Tolls are when you go on the highway, you have to pay the $1, the $2 to go through the highway and use the advantage so you don't have to go through the streets and take the red lights and the stop signs and all that stuff. It pretty much expedites your journey to wherever it is that you're going to go, whether you're going to the beach, the gym. You want to take the highway, you got to pay the price. You want to enter a trade through a broker, you got to pay the price. Now, the only difference in between the tolls on the highway and the spread in the markets is that the spreads in the markets, they fluctuate. They can be really, really expensive, or they can be really, really cheap to almost even free. Now, this is all based off of what time we're executing this trade, and I'm going to explain in just a second. The tolls on the highway don't change the prices because it's just a standard thing. You pass through the toll point, they're going to charge you $1, $2, whatever it is that they charge, whether there's a lot of people or whether there is a little bit of people. Whether it's traffic hour, no traffic hour, they're going to charge you the same fee every single time. This never changes. Now, in the market, it changes based off of how many people are executing the market at that time. The more people are in the market, the less fee they're going to charge. The less people in the market, the more fee they're going to charge. Now think of it as a very simple way. The more people that are in the market means the lower they can the lower that they can have the spread, because there's more money being moved. So they're making their money on volume and not a little bit amount of people. But if there's a little bit amount of people, they have to make their money by charging more. It's very simple. So if you're going to enter a trade and you have a high spread, just take that into consideration. You know, spreads, sometimes they can cost $5, $10, 20, simply depends how much you're going to risk. But I'm telling you right now, it is absolutely inevitable. It is the cost of doing business. You have to pay it if you want your trade to get executed into the market immediately through a broker. And honestly, we're retail traders, we kind of don't have a choice. But when you win a trade, it's a very, very small percentage. It's probably 1 to 2% of whatever you're going to actually risk onto your trade. And you'll notice that as soon as you enter the trade, you're automatically negative. That is because the broker is going to charge you that fee, that spread fee, as soon as they enter the trade. They don't care if you win or lose. They already got their fee because they already executed your trade into the market. So you don't have to pay it. You know, you can't choose when to pay it because you're going to automatically pay it right at the beginning. And there's nothing that you can do about it. You just simply have to be on the lookout and make sure that when you're entering the trade, your spreads are lower than higher. And this is going to be a major key because I've personally not taken trades because of how high the spread is. And you're probably wondering why. Well, think about it. Let's say I am setting myself up to risk $100 on a trade to win $200. But the spread is $100 to enter the trade. Well, I'm not going to enter the trade because automatically as soon as I enter, I'm going to lose $100 on the fee no matter what. And then if I were to lose the trade, I would lose another $100. So I'm losing more than I anticipated. But if I were to win the trade, I would only make $100 because they already took $100 out of the spread. And this usually happens in sessions when there is nobody in the market and they simply have to charge you a lot to execute these trades into the market. But honestly, this pretty much is not going to happen to you because you're only going to focus on taking trades at the right session. And that leads me to this next point, which is going to be what are the right trading sessions in the market? And let me tell you, this is major key because it pretty much comes down to wherever you are in the world watching this video. Trading sessions are different for everybody because the trading sessions will always happen at the same time, but depends where you are in the world with your time zone, how is that going to affect you? And I'll explain right now. So these are going to be the 4 trading sessions in the market of the currencies, right? So it consists of Sydney, Tokyo, London, and New York. And out of these 4 sessions, only 2 of them are going to be the ones that you will only be executing trades in, because if not, the spread will simply eat you up. So if you come to here to the market, you guys can see that Sydney and Tokyo will be happening at these times GMT. So you have to make sure you calculate this based off of where you are in the world. Then you have London session and then New York session. As you can see right here, this is the main trading session. You want to enter either at the beginning or during London session so the trades can push throughout all of London and all of New York and continue with the momentum, because Sydney and Tokyo have absolutely no volume in those sessions. Why? Because the big banks are closed and there's no money being moved here. Doesn't matter what currency pair it is. Now, this is going to be a very blurry picture, but I'm just going to show you the example of where there is more volume and where there is less volume. So clearly you can see these zones right here that are dark green are going to be where the majority of the volume will be in. And then the areas where it's light green or almost white, there's absolutely no volume. There's nothing you should be doing in these zones because there is no money being moved. Spread is very high and the market itself simply won't be moving that much because there's no volume, there's no momentum. Volume also equals market momentum, trading session, so on and so forth. There's just no movement in the market. So these sessions right here, Sydney session and Tokyo section, are very low volume. It's very expensive to trade in these sessions, and on top of that, there's no market volume, so there's no market movements happening at that time. The market moves with volume, so you want to trade at sessions where there's a lot more volume. As you can see right here, it's the beginning of London session, and you can see right here when New York and London session overlap, there's this massive chaos that happens because there's a lot of volume. This is where you'll have the big swings up or the big swings down. And then pretty much after London session and New York session overlap ends, pretty much starts to die down and slow down then. So you should only be looking to enter trades in between the beginning of London and the ending of London session, kind of where it also meets the middle of New York session. If you enter the trade in this session and it has not hit your take profit just yet or your stop loss, you simply set and forget, and you're going to be holding throughout Sydney and Tokyo section until the next London and New York session, which your trade should hit take profit or stop loss. So you guys can see here how if you were to look at it on EST, London session begins at 3 a.m. EST. Let me tell you, it sucks. I hate waking up at 3 in the morning. But
it pays. If you're gonna make 100K on a trade, I guarantee you'll wake up at 3 in the morning. So you just have to see where you are in the world to see what time is London session for you. I know traders over in London get very great trading sessions because they have London session right in the morning and then New York session right in the afternoon. So you're kind of trading throughout your regular 9 to 5 schedule versus over here in Miami time, EST. Kind of sucks. You have to pretty much be like a vampire and trade at night and trade in the morning as well. So this all depends where you are in the world, and you only want to focus in trading in London session and in New York session because it's the only session that there is volume. Volume equals less spread, more movement. No volume equals more spread, less movement, and you don't want to be involved in that. And I don't make the rules, the market does. You can try and go trade Sydney and Tokyo and you're going to see how fast you will get humbled. Trust me, I would much rather trade those sessions because of my time zone, but simply doesn't work. There's no session. There's no volume in those sessions. There's nothing that I can do about it. So those are the times that you can trade. Now that you understand that these are the times that you can trade, it's time for you to hit the subscribe button. Just subscribe. You're this far into the video and you're not subscribed. Shame on you. But no, seriously, after you subscribed, you're going to want to make sure you stick around for this because it's the inevitable in trading and it's going to be slippage. What is slippage and how can you avoid it? What can you do about it? And the answer is nothing. There's nothing you can do about slippage. Well, there's actually one thing you can do about it, and that is not trade in the sessions you shouldn't be trading. Think of slippage like when shit happens in your life. Like, let's say you're simply just walking out of the store with the groceries and the grocery bag breaks. Damn, that sucks. You don't want that to happen, but shit happens. You have to pick everything up, get another grocery bag, and move on about your day. It's like when you order coffee and you're walking to your car, you trip, you drop your whole entire coffee. You simply have to get the cup, throw it away, and go get another one. Shit simply happens. It's inevitable. There's nothing you can do about it. You can learn from it and, watch out for wherever you tripped. You can make sure next time you double bag, but shit happens. You're gonna mess up, right? It's part of life. Well, slippage is kind of as the same thing. Sometimes the market doesn't have enough liquidity. Sometimes the volume isn't there. There's not enough movement, and the price can either miss your stop loss, miss your take profit, or you're just going to get charged more. It's called slippage. Now, there are many different ways on how to look at this. You can look at this as the broker's fault. You can look at it as the platform's fault. Or you can just simply realize that you took a trade out of session and you took a trade when you weren't supposed to, and you had a super tight stop loss and news came out. It's just so many different things can come into it, but it just simply comes down to you just trading at the right session. If you trade outside of the sessions, you will not catch slippage. You want to make sure that you are only trading in the right session. And even as well, sometimes you can put 2 bags and you can sometimes hold the coffee with 2 cups, and you can hold the coffee with 2 hands, but you will still probably trip. The bag will still break. It's just shit that happens. If I were to simply say how many times I get slippage, let's say out of 10 trades, maybe 1, maybe. And when that happens, it sucks because that always happens to be the winning trade. I don't know why, it's the coincidence. The day that you order the coffee and it spills is the day you need it the most. The day that you get the groceries is the day that you were hungry the most. It just happens. It's part of life. It's part of your trading routine. Slippage is simply when the broker or the market does not have enough volume. So they're going to miss your stop loss, they're going to miss your take profit, and they're going to charge you more. It sucks, but it's part of the process. And the exact reason on why this happens is because let's say you have your stop loss at 1.500, and that is where you want to have your take profit. Well, if when price gets to 1.500 and there's nobody in the liquidity closing that trade out on the other side, or there's simply no money being traded at 1.500, the broker can't give you that money because nobody else is placing that other bet. So how are they going to give you money on something that doesn't exist? So there has to be a different player in the game to execute that trade on the other side. Well, if it's not there, they can't give it to you. So let's say somebody is at 1.4950, so 5 pips below you. Well, they can give you that one because that's where they have the liquidity at. So that's why you'll make a little bit less. Or let's say it's at 1.400. Now it's 10 points less and it sucks. The same thing happens with your stop loss. Let's say you have your stop loss at 1.000 and the market gets to 1.000 and there's no liquidity there and price keeps going down. They can only close you out wherever they have the liquidity. And if they have the liquidity at 0.9500, well, you just lost an extra 50 pips because the market simply didn't have it. It sucks, but honestly, the odds of this happening are slim to none with this, great magnitude. Next, we're going to talk. So now that we understand that slippage is inevitable, let's talk about what isn't, and that is going to be leverage. So leverage is something that a broker pretty much requires for you to have when you're creating these accounts. On whatever broker it is that you're going to choose, you're going to have to select the leverage 1 to 50, 1 to 100, 1 to 200, 1 to 500, 1 to 1000. Right? So when you first think of leverage, the first thing that should come to your mind is you are leveraging something for something. You're leveraging one thing to get another thing in return. We use it on an everyday basis, business, credit cards, we leverage all the time. So in trading, it makes no difference, but it's the type of way how it's leveraged. For example, 1 to 150 means for every $1 that you have in the account, you have a buying power of $50. If you have a 1 to 100, for every $1 that you deposit into the account, the broker will give you 100 times that buying power. So obviously, the higher the leverage, the better, because you can essentially use this credits or this money that the broker is giving you, right? They're actually not handing you money. They're just giving you more buying power with your money to execute trades into the market. Now, the higher the leverage, the higher risk. The lower the leverage, the lower risk. I personally do not recommend any more than a 1 to 100 leverage. You do not need 100 times more money than you are depositing into the platform. It just simply makes no sense and you don't need it. The highest leverage I personally use right now is a 1 to 50 because obviously I'm risking a lot more money and I don't want to have the ability or the exposure to be able to use more of that. Because if you don't have a high leverage, if for whatever reason you get slippage, the broker literally cannot slip you out more than the money that they're allowing you to risk and more money than the leverage that they're giving you. So it's kind of a trap that you are forcing the broker because that way they pretty much have to take a loss on your position if they can't liquidate at the point where you are because the leverage simply doesn't let you. So basically, to sum it up, leverage is literally what it is. You're leveraging more money that the broker is going to give you, and for every dollar it's X multiplier on whatever percentage that they're going to give you. 1 to 50, 1 to 500. I don't recommend more than 1 to 100. You don't need more to succeed in trading. So now that we understand what leverage is and how you can use it to your advantage and pretty much all the technical aspects of trading, let's get into the most important topic in trading. Get like a little drum roll, editors. This is the most intimidating and the most challenging parts of any trader that comes into the market. That is going to be psychology. So we're going to be now talking about the psychology battle that you will be facing yourself as a trader when you begin this never-ending journey to become a successful trader. And I say never-ending because I am already a successful and profitable trader, and I still battle with psychology. Now, obviously, not to the same degree or the same level as I did 5 years ago, 4 years ago, 3 years ago, but it's a different type of psychology and different types of emotions, but it's still there. It's just at a different level, but all of you guys will get to that level eventually. And every single level that you grow, you leave one behind, but you unlock a new level of emotions, fear, greed, so on and so forth. So let's begin. Now, I want you to keep in mind that this isn't something that I realized was important in trading into about a year into my journey, because the person that you come into trading is not the person that you come out on the other side. You literally come out on the other side as a completely different person. Like, I've seen people that they would, smoke weed, they would party, they would be lazy, watch movies, that they would get their attention grabbed by trading, they'd get started, and a year down the road, they no longer do drugs, they meditate every morning, they read a book. Like, trading will literally turn you into like a completely new person. You're going to visit parts of your emotions, and you're going to learn things about you that no other journey will teach, because everything in trading is determined by you. It is determined by the effort and by the point-on-point mistakes that you do. If every single point mistake you do, you avoid it, you're going to be the only one that knows, and you're going to be the only one that pays for it. If every single point-by-point mistake you learn from it and you move on, you are going to be the only one that knows, and you're going to be the only one that grows from it. So everything that you do in trading, you will be the only one that knows. You will be the only one that keeps yourself accountable, and you will be the only one that gets the benefit of it and will know if you're actually doing it. And that's freedom of accountability, and that freedom of being able to do what you want, when you want, hold yourself accountable if you want, when you want, how you want, is a very big double-edged sword. Because you can choose to point the finger at yourself whenever you want, whenever it's most convenient. But whenever you don't want to, you can point it to the market, you can point it to the broker, or truthfully, to whoever you want to put the blame on. And at the end of the day, whoever you put the blame on, no one's going to come and tell you anything, because no one cares if you win or lose. At the end of the day, it's just you and the market. And this is where you will visit the famous 6 different aspects of your personal self with your emotions and the battles that you will be facing. You will be facing greed, fear, FOMO, money management, accountability, and procrastination. And all of these are going to be the 6 different psychology traits that will either end you or make you. The first psychology barrier that you're going to battle with immediately is going to be greed. You go on Instagram and you see a bunch of these traders making $50,000, $100,000 a day, $200,000 a day, and you automatically think, I'm late. I'm doing something wrong. I should be in that position tomorrow. I should be in that position yesterday, the week before. I've been, not doing the things right. This next trade that I make, I have to make the same amount as that person. And you're already making the first mistake. And that is, you're being extremely greedy, looking at other people's pockets and looking at other people's trades, comparing it to your own. Why are you going to base somebody else's decade in the market to your first week in trading, your first month, even your first year? That's not how it goes. If I were to be in the gym for 10 years and I have 6 packs and I have a great body, and it's your first week that you come into the gym and you try and lift the same weights as me and you're trying to keep up in the cardio with me, it's almost disrespectful, because you're almost not even respecting the time that I put into it and the consistency that I did to get the results that I do. And if you expect that you, by coming in your first week, you're going to remotely get anywhere near close to what I have, it's just simply unrealistic. You're simply having an illusion of what you think you can possibly be within that short amount of time span. I'm a living proof that you can do it, but with time and consistency. Now, your greed is going to determine if you're going to put in that time or if you are not. And by this, greed is going to be the first thing that will knock you down, because you simply aren't accepting who you are at that very point in time and realizing that you're not ready to make 10K a day or 20, 30, 40K a day, because you haven't even made your first $1,000 a day. So your greed has to completely be removed, so you are now able to be content with yourself and the results that you are having, so you can continue to grow within the market at the pace that you should be growing. Not just wanting to jump from level 1 to level 50 in 1 week because
reanalyzed the same chart that week, or because you copied the same trade that I had for whatever reason. And now you are saying, well, I caught the same trade as him, I should make the same money as him. No, that is not how this works. Just because we're training at the same gym doesn't mean that we're gonna have the same results. Next is going to be fear. Because as soon as you overcome greed, then fear awaits you right there. It's almost like you get over greed and now you got to get over fear. Because now that you realize that you're not at that level yet, that it's going to take time, well, now you're scared of either risking the money that you should, you're scared of making the money you should, you're scared of the unknown, you're scared of losing too much, you're scared of winning too much, you're just scared of everything as a whole. And I get it, it can be very intimidating because you have pretty much nobody to talk to, right? Like at the end of the day, us traders, we're in this shit alone. Like you can't ask anybody in your family. I guarantee you nobody in your family knows what the hell this is. You can't ask any friends because none of your friends have the same vision, the same ambition as you, so you're kind of alone. And this fear, you kind of just have to swallow it yourself, because you don't want to, you know, put it out there to people that have no idea what this is, so they're not going to know how to help you. And by you doing this, you're actually just doing more damage to yourself in a way, because you can't just talk to somebody about money management and, you know, wins and losses where they don't even know what a pip is. So this fear is something that you have to overcome on your own. You can't get consulting from anybody outside of trading because they simply won't understand and they won't connect with it. And their advice, if anything, it could be damaging due to the fact to their lack of education. Now, they're not purposely trying to harm you, but they will harm you due to their lack of information and, you know, awareness to the opportunity that this space brings. And the simplest way of getting over fear is simply by showing up every single day. And if the market's gonna punch you, just get ready for the hit. You know that in a couple of hours after you get punched in the face, you'll be fine. And if, you know, next time you see the punch coming, you know that, you know, clench a little bit, and then over time, you know to duck and you know to start avoiding it. There's nothing you can do about it other than just face your fears, and over time, your fears are going to make you the winner that you will be at the end of the day, because you learn from those mistakes. Fear can come in many different ways. It can either come from losing money, scared to take a trade, scared to try new things. At the end of the day, it simply comes down to you having to face your fears to be able to learn from the mistakes that you will make, and then you move on and you capitalize from them. And as soon as you're finishing the battle of getting over your fears and learning from them, you're gonna enter the new battle that is kind of greed and fear at the same time, and that's gonna be FOMO, which is going to be fear of missing out. And your fear of missing out is only going to be because you have been putting time into the market and you understand there's opportunities in the market, and you've seen the opportunities to capitalize off of it. You've seen the opportunities, you've made money, you've lost money, and now you're at the point where you know the opportunity is there, but you simply have fear of missing out, and you don't want to miss out. You want to be involved as much as possible so you can capitalize from these opportunities. And this is something that it took me about, I say, 2 to 3 months to get over. Luckily, I was getting over it pretty quick, because I simply woke up one day and I realized, I'm like, what do I have fear of missing out on? What is it? Money, right? I'm scared of missing out on the opportunity to make money with this skill set that I have learned, or I'm learning. And then I asked myself, well, are these opportunities going to end? And instantly I said, yes, like I have to get it before they run out. But then I had more of a logical answer. I'm like, well, probably not. The markets are going to be here for the next 10 to 15 years. So why do I have to catch every trade? Why do I have to chase trades? Why do I have to take trades that don't make sense? Why am I trying to chase the money when the money's going to be here for the next 10 to 15 years? Well, that's where I got a reality check and where everything changed for me, because I realized that me chasing these trades, or me wanting to get these trades that were running away, and me having fear of missing out of these trades that were running away,